now live.
Well, good morning, everyone. Welcome to this meeting of the Pensions Committee. I am obliged to inform you that this meeting is being live streamed and recorded. Members of the public will be able to view the meeting using the link on the agenda. And as a piece of housekeeping, everyone present in this room is to wear a mask, face mask during the meeting, but you are allowed to obviously take it off when you are speaking. Without further ado, we will now move to item 2 on the agenda, apologies and substitutions. And I believe we have no apologies and therefore no substitutions. I would just like to take the opportunity, though, of recording the committee's thanks to Laura Hoskisson, who has retired from the committee. I think it was back in October, November time, and she wrote me a very nice email, and I also wrote back to her and thanked her for her service on behalf of this committee. Item 3, disclosable interests. Are there any disclosable? Roger, yes?
I am a Shropshire councillor pensioner. I'm not sure if that's pecuniary or not, but it's, I thought it needed to be noted at this time.
Okay, thank you, Roger, very much. Do we do any other? No. Okay, that's fine.
Chair, can I just check? Is that a pecuniary interest? In which case, I also have to declare it.
I don't think it is.
It's not.
I don't think it is.
Okay,
It's helpful to declare it.
I mean, me too, but I took the advice and started by the one. Yeah.
It's not. No. But thank you for that, Roger. Anyway, minutes of the last meeting. The minutes have all been circulated. This was the meeting held on the 17th of September 2021. Is everyone happy that we approve them? Roger.
Chairman, for accuracy, I note on page 8 of the agenda, it notes at the top of that page 2 votes against item 17. Now, in the minutes, I presume it is item 33 that is listed there. 17 on that council agenda, but in these minutes there is no number 17.
It would have been on item 31, wouldn't it? The exclusion of press and public, if I remember rightly.
So you know, 2 votes against item 17 being exempted from it. It was a particular item on that agenda which I and another member voted against and thought that that item should be in the public domain. That's another argument. Okay.
Yep. We'll note
just
that.
17.
Yep.
I think it should have been 33. That's right.
Okay. We're happy with noting that, Sarah. Yeah. Okay. That's noted, Roger. Thank you for that. I'll move the minutes. Can I have a seconder, please? Simon. Thank you. Everybody in favour? Yep. Thank you very much indeed. We now move on to public questions. We have received 6 questions in all, and Justin will kindly read out the question and James will read out the response. So the first question is from Claire Cooper.
Thank you, Chair. Question is, since the fund aims to help manage climate change and has undergone extensive training, this is my question. Has the committee had any presentations from climate scientists in the last 18 months? If so, please give details of the names and qualifications of the scientists and the relevant dates.
And the response, please, James.
Thank you, Chair. Response is no, as no one is questioning the science behind climate change. Thank you.
Thank you. The second question is from Chris Welsh.
The Council's divestment motion of July 2020 was supported by Shropshire Council and Telford and Wrekin Council. The pension fund has sought to minimise the weight of these council decisions by commenting that they are just to the fund's 160 employers. Will the committee acknowledge that Shropshire Council and Shropshire and Wrekin Council between them represent a substantial majority in terms of payments into the fund, contributing over 60% of employer contributions? That's the first part of the question.
There's two parts to this question, so that's the first part, and we'll have the answer to the first part, please.
Thank you, Chair. Shropshire County Pension Fund is a long-term investor representing over 50,000 members, only some of whom are current active members making contributions. Shropshire Council and Telford and Wrekin Council employer pension contributions amounted to £27.6 million in 2020-21. This represents 1.26% of the total fund value of 2.194 billion as at the 31st of March 2021.
Okay, thank you. And the second part of the question, please.
Thank you, Chair. Other employers have also supported the divestment motion, notably the Seven Gorge Countryside Trust and town councils including Shrewsbury, Oswestry, Wem and Much Wenlock.
And the response, please.
Chair, that is correct. For context, the total active, deferred and pensioner membership numbers of these employers amount to 174 members out of the Shropshire County Pension Fund membership of over 50,000.
Okay, thank you very much. Question 3 from Paul Cooper, please.
Today, the Shropshire County Pension Fund is set to make a historic choice between the policy of engaging with fossil fuel companies to seek change or divesting from them as being financially unreliable and climatically and environmentally ruinous. Given the huge amount of public interest in this issue right now, I and other pension fund members are not happy to have never been balloted on this issue, an issue that affects far more than our pensioners since it decides our very survival on this planet. Will the committee take the courageous decision to divest from fossil fuels or defer a decision until pension members have been balloted?
And the response, please.
Chair, it is wholly inaccurate to suggest the issues cited in this question affect any member's pensions. Shropshire County Pension Fund is a defined benefit scheme. The pension fund has responsibility for approving the fund's investment strategy following detailed advice from investment advisors, its independent advisor, officers and Lgps Central, its investment pooling company. Decisions are made in accordance with this strategy by strong and robust governance arrangements. The investment strategy statement, climate strategy statement and stewardship plan and funding strategy statement are all consulted on with employers of the fund. Thank you.
Thank you. And the fourth question from Dr. Jamie Russell.
Thank you, Chair. Shropshire County Pension Fund's 2021 Climate Risk Report, prepared by Lgps Central, relies on the IPCC's Climate Change 2013, the Physical Science Basis, part of the IPCC Fifth Assessment Report, AR5. However, in August last year, the IPCC published an updated report, Climate Change 2021, the Physical Science Basis, part of the IPCC Sixth Assessment Report, AR6. Much has changed in the 8 years from 2013 to 2021, and there are critical differences in the findings of these reports. For example, the 2021 report states evidence of observed changes in extremes such as heat waves, heavy precipitation, droughts and tropical cyclones, and in particular, that attribution to human influence has strengthened since the Fifth Assessment Report, AR5. Furthermore, the European Union's Copernicus Satellite Agency recently reported that globally, the 7 hottest years on record were the last 7, 2015 to 2021, by a clear margin. Shropshire County Pension Fund's 2021 Climate Risk Report does not even mention this significant and sustained increase in global average temperature. Please can the committee explain why the Climate Risk Report relies on the IPCC's 2013 report when the 2021 report was readily available? As a matter of utmost urgency, will the committee now commission a reliable and accurate climate risk report, prepared by genuinely independent experts and based on the most recent understanding of climate science and include an analysis of the accelerating climate changes of the last 8+ years. Will the committee then review any decision on divestment in light of this more accurate information?
Thank you. And the response?
Thank you, Chair. It is accepted that by being one of the first pension funds in the country to commission a climate risk report, there will be more information that becomes available to later adopters as time progresses. Shropshire County Pension Fund's 2021 Climate Risk Report was commissioned in April 21, several months prior to the release of the IPCC 6th Assessment Report AR6. The IPCC 5th Assessment Report AR5 is one of the many sources of information used in the preparation of the climate risk reports. However, more recent and up-to-date references are more heavily relied upon and include the IPCC Special Report on 1.5 degrees Celsius. We want to be clear that these scientific analyses form the foundations of the climate risk reports and are the principal reasons why the reports were originally commissioned. Shropshire County Pension Fund recognises that climate action failure is the standout risk the world faces in likelihood and impact, and has committed to using the best available tools to identify, understand and assess this risk. As such, the tools used in the climate risk report do include some of the best available techniques to analyse climate change risks. Section 4.4 relies on data from MSCI, a fully independent third-party vendor. MSCI source their carbon data from publicly available sources, using robust estimation methodologies where data is not available. An LGPS central report on these MSCI provided figures in the climate risk report. The metrics analysed in section 4.4 are in accordance with the Task Force on Climate-related Financial Disclosures reporting requirements and the GHG protocol, greenhouse gas. In addition, the climate scenario analysis utilised in 2020 was provided by Mercer, another entirely independent third-party provider. Any future climate risk reports will continue to ensure that the best available techniques sourced from fully independent expert providers are utilised and that the most recent scientific information is reflected within. Thank you.
Thank you very much. And the next question, question 5, is from Suzanne Freegard, please.
Thank you, Chair. The Council motion report for this meeting states Pension Committee members have been on an extensive programme of training provided by responsible investment and climate change industry experts and investment managers on all climate-related issues over the last 18 months. Approximately how many hours of training did the members of the committee receive in total? And of this, how many hours were spent examining the case for divestment from fossil fuels? Which organisations provided training on divestment and how were they selected? Which of these were providing engagement services to Shropshire County Pension Fund and which were not? And which provided case studies on the process of divesting and on positive experience of divesting?
Thank you. And the response, please.
Thank you, Chair. Details of all training provided over the last 18 months are included within the table in paragraph 13.1 of the Council motion report later on this agenda. All Pension Committee agendas, reports and papers appear on the Council's website with names of the organisations and individuals delivering the training. Members have also attended webinars and Responsible Investment Summit Training Day on the 13th of October 2021, run by Lgps Central, which all Pension Committee and Pension Board members were invited to. A host of responsible investment industry experts from both the public and private sector presented at this all-day virtual event. Thank you.
Thank you. And the final question, question 6, is from Nat Harlow.
Don't Look Up is a satirical Hollywood film starring Leonardo DiCaprio as a scientist who is trying to warn the world about an impending comet strike that will wipe out all life on Earth. No one listens to the science and everyone refuses to look up, encouraged by vested interest to believe that all will be well. Do members of the Pension Committee feel that they have sufficiently listened to the science on the climate crisis and the need to divest from fossil fuels? Are they looking up at the impending disaster or down at the ground?
Thank you. And the response, please.
Thank you, Chair. The science behind climate change has not been challenged by any Pension Committee members. Pension Committee members have, nevertheless, been on an extensive programme of training over the last 18 months on climate-related issues and in relation to their responsibilities. Thank you.
Thank you very much. That concludes item 5, public questions. We now move on to a 3-minute presentation, which is going to be given by Joanna Blackman on behalf of Fossil Free Shropshire. And I believe you've also got some postcards that you would like to present to the Pensions Committee.
Thank you. Yes, I have a stack of postcards here, 1,000 postcards from members of the public calling on the fund to divest.
Thank you very much. So 3 minutes, please. Thank you.
Members of the committee, I have 3 questions for you as you consider the divestment motion. Firstly, where does your fiduciary duty lie? Last year, the International Energy Agency made it clear that there can be no new fossil fuel exploration. And an analysis by Oil Change International shows that to have even a 50-50 chance of keeping within 1.5 degrees, we can at most extract 1/3 of developed reserves. Warnings about the risk to investors of volatile fossil fuel performance and stranded assets arrive almost daily as the world realises that new oil and gas is incompatible with the 1.5 target. Following COP26, the Chief Executive of the Environment Agency warned that investments in coal, oil and other forms of dirty energy are no longer safe bets. Smart companies, including smart banks, are getting out of carbon fast and divesting themselves of what will soon be stranded assets. So, divestment becomes a fiduciary duty because fossil fuel investments are increasingly unsafe. Secondly, what legal challenges might the fund face if it continues to invest in fossil fuels, knowing what it does now about the threats posed by the climate emergency? According to studies by LSE and the UN, climate litigation cases have surged in recent years and pose a risk to an expanding range of companies. Just last week, papers were filed against the UK government claiming that its net zero strategy fails to include the policies needed to deliver the promised emissions cuts. Thirdly, what are your moral responsibilities in the light of the global climate emergency? Last year, Sir David King, former UK Chief Scientific Advisor, said, "We have to move rapidly. What we do over the next 3 to 4 years is going to determine the future of humanity. We are in a very, very desperate situation." Engagement is simply not capable of delivering the far-reaching changes required within this time frame. Many investors recognise this, including Dutch pension giant APB, which recently sold its 15 billion euros in fossil fuel holdings, announcing that they saw insufficient opportunity for us as a shareholder to push for the necessary significant acceleration of the energy transition. The good news is that there are plenty of profitable investments in green energy and technology. A study by Imperial College and the IEA found that investments in renewables vastly outperformed fossil fuels over the past decade. In conclusion, you have an opportunity today to cease involvement with fossil fuels and, in the words of UN Climate Chief Patricia Espinosa, to stop investing in our own extinction. I urge the committee to align itself with the tide of public opinion and the wishes of employers, fulfil its fiduciary duties and be on the right side of history. Thank you.
Thank you very much indeed. We will now move on to item 7, which is an Lgps central update, and Gordon Ross from LGPS Central will kindly take us through that. Over to you, Gordon.
Thank you very much, Chair. Thank you. First, I must apologise. Our CEO was meant to be representing us, but unfortunately, due to family bereavement, he couldn't make it. My name is Gordon Ross. I'm Chief Investment Officer at LGPS Central. You have in front of you a small pack, which for the next 10 minutes or so, I will go through some of the history behind pooling, where we are currently 4 years down the road, and the relationship we have with Shropshire County Pension Fund. So what is pooling? Where did it emanate from? It was an idea first brought out in 2013, when the then local authority minister, Brandon Lewis, made a statement that he was not wedded to having multiple, in this case 89 pools within the UK, within England and Wales, and was more focused on efficiencies, cost savings, and making the most of the purchasing power. This then emanated into a paper in November 2015, where some principles were set out by the government, against which the authorities were invited to put forward some half a dozen proposed rules. Scale being one of the important things, there was a minimum of 25 billion set for the ideal target or minimum target of a pool. Savings, there are no set targets for savings, but obviously with the aggregation of pension schemes, the purchasing power with external managers would be increased, and therefore substantial expectation of savings expected. Good governance was very much at the forefront to make sure that it was a system and a set of rules whereby they will be able to represent the best practice, best in breed at the local authority pension scheme level. And obviously to do more on infrastructure being a major source of investments and revenue. There was again no target, but the investments were focused on infrastructure. So rolling forward to some February 2016, submissions were made by 8 groups, 8 pools, and these were basically aligned to natural allies within areas, geographical neighbours, or some such strategic like-minded thinking. And therefore, on the 3rd of April 2018, LGPS Central was open for business. It's a regulated entity by the FCA. So, rolling the clock forward to today, where have we come? LGPS Central has around 25 billion assets under management. These numbers were dated back in September. As at the end of the year 2021, these numbers have gone to about 27 billion, of which these are divided between, as you'll see, funds managed either internally or externally, or funds advised on. The vehicles we have for our pool members, including Shropshire, now amount to some 19, with some more planned for release and construction over the next year or so. And the staff at LGPS Central, which is based in Wolverhampton, has grown to some 66 members, including investment support staff, analysts, both in the private and the public markets. Cost savings being one of the major focuses for the concept of pooling. We are well on the way to targeting around 270 million in cost savings net by 2030, 33, 34, which is the target date for measurement. Based and fundamental to our belief is responsible investment. It's embedded in everything we do. It's embedded in all products we run, both internally and externally. And we have made commitments to net zero and signatories to the Stewardship Code 2020. We have a dedicated expert team focusing on RI&E and ESG, and you'll be hearing from some of them later in the meeting. From a compliance point of view, we had an unqualified AAF report, which means that we were basically in control of all our rules and regulations, making sure that we were practicing best practices and keeping the business open and in a regulated manner. This requires annual reports to the FCA. So on the next slide, a product overview. We have products issued in both what we address to be the public market and the private market. Public markets is where you will see quotes from equities or fixed income in the public sector. The private markets are very much what we would call OTC. These are investments in such things as infrastructure, as in property, in private debt and private equity. You can see before you the list of the current funds, the 19 funds we run, divided into passive. These passive funds are designed to replicate indexes. They are either the complete, which means you buy every single stock in the index, or some form of sampling. Therefore, if a stock or a company is in the index, it would be in the passive fund, provided that that entity was in the index. We have global and UK. We have dividend growth, multi-factor funds, and more recently, the climate multi-factor fund, which is focused on factors including a reduction in fossil fuels and alignment. As far as the performance goes of these funds, the passive funds are measured to perform in line with the index. We measure them from a performance point of view on a tracking error. So how much variance is there between the fund performance and the index performance? And as at the end of 2021, all 5 were in line with their tracking error. On the active funds, we run active funds, multi-managers multi-manager global and emerging market equities, and some fixed income funds. These are all managed by external managers, whereas the passive are run in-house by Lgps Central. They all have benchmarks and target outperformance. And at the end of the year, all these 5 funds were in line or beating their benchmark, although under their target. And then lastly on this slide, the private markets. These are private equities, private debt markets, infrastructure and property. And we originally had a private equity partnership. This was lending to private entities in 2018. We call it the 2018 vintage, and we have recently launched and closed the 2021 vintage. Performance of all these funds can be seen in the appendix of the pack that you have in front of you. So how does Lgps Central and Shropshire Pension work together? We work very much with yourselves and with the other partner funds in designing products that align to your investment requirements. You're responsible with your advisors for your strategic asset allocation, and from that you devolve the asset classes you wish to invest in. Together with the other 7 pension schemes, pools, we look at investing into entities, into solutions that are along the lines of your strategic asset allocation. Unique to yourselves and one other pool member, we are currently working on a targeted return fund, which is a low correlation fund using multiple asset classes. A low correlation fund to equities, which again benefits from diversification and reduction in risk. We are also launching a sustainable equity fund, which is looking to invest in sustainable companies, publicly quoted companies, and to increase our allocation and exposure to the property market. The combined purchasing power of the 8 partner funds that make up Central's pool have allowed us to reduce management fees and work more efficiently across the asset classes. We also are able to do a large amount of what we call the heavy lifting as far as reporting goes, detailed reporting to pension schemes, both at the asset class and obviously at the ESG level. We continue to grow a dedicated staff, which meets regularly with the pension scheme and pension fund, as you see, and looking to work continuously in partnership with ourselves and Shropshire. We believe we have a very strong relationship with Shropshire County Pension Fund. We continue to develop the products needed for your needs and our other pool members' needs, and have a very close focus on the performance and the ongoing design of these products to make sure they're fit for purpose on a continuing basis. Thank you very much.
Thank you, Gordon, very much for that. Are there any questions or comments, please, members? Yes, Roger.
Thank you, Chairman. Thank you, Chairman. On the climate risk report.
We're looking at the climate risk report next.
Okay.
This is just the report from LGPS Central. It's the LGPS update. We're next item on the agenda, item 8, is the climate risk report. So if you can hold on till then, that would be great. Any other questions? No? Well, thank you very much, Gordon. Very interesting. Thank you. Item 8 we move on to, and this is the climate risk report. I believe it's our second report, and significant progress has been made, and this is going to be presented to us by Patrick O'Hara, who's present today, and I believe also Laura Mitchie as well, who will be over there virtually. So it's very much a hybrid meeting. So over to both Laura and Patrick, please. Thank you.
Thank you very much. Good morning, everyone, and many thanks for having us today. My name is Laura Mitchie, and I'm one of the RI&E analysts from LGPS Central. And I'm joined today by my colleague, Patrick O'Hara, who's there with you in person, who is the Director of RI&E at LGPS Central. So today we will be presenting the findings from Shropshire County Pension Fund's 2021 Climate Risk Report. So a report commissioned by Shropshire and written by LGPS Central. The purpose of the presentation is to really present the main findings of the report. So I'll begin by giving an introduction to the Climate Risk Report, outlining what the purpose of the report is, the questions it looks to answer, and how it can be used by the fund. I will go through each of the main analytical sections in turn, and the main 3 sections we are going to be focusing on today are governance, carbon risk metrics, and the climate stewardship plan. So just beginning with what the report is aiming to do, the climate risk report aims to identify, as far as we can, the financially and material risks and opportunities that the fund might be exposed to from a climate change perspective. We are not looking at whether there is an ethical or moral question. What we are looking at is whether climate risk translates into a financial risk. And I want to be clear from the outset that we're not claiming that this report has all the answers. Climate change is clearly a highly complex issue, one which will likely affect all asset classes, sectors and regions. And as a result, there are limitations that we have to consider. What we do think, however, is that investors looking to manage climate risk proactively ought to attempt an inference to the best explanation. And this is really what the report seeks to do. It aims to draw on some of the best methodologies we can find to help the fund consider and understand both the types of climate risks it may be exposed to and what it can do to manage those risks. Now, as it has been said, this is Shropshire County Pension Fund's second year on second climate risk report. In the first climate risk report, the 2020 version, we were able to gather a baseline of data. This was useful last year for telling the fund where it was at that point in time in terms of its climate risk management. What we are able to do now is compare those results to the data we gathered this year. We're able to measure the progress against the baseline and demonstrate in quantitative terms how far the fund has come in the last year. So just before we dive into the findings, the climate risk report is structured in line with the 4 pillars of the Task Force on Climate Related Financial Disclosures, the TCFD reporting. And the TCFD is a way in which organisations, and that includes pension funds, can report on their climate risk management. Now, the first pillar of the TCFD is about governance, so the policies that the fund has in place. So if you have the report in front of you, could you please turn to page 8. So based on our analysis in the first climate risk report of the fund's policies, we provided 16 recommendations to Shropshire County Pension Fund, all things which, in our view, would further embed and normalise the management of climate risk into the fund's governance and policy. And just to note, these recommendations all had kind of a medium-term horizon, so they were not designed to be implemented, absolutely immediately. Over the past 15 months, Shropshire has implemented 14 of those recommendations, and this includes developing a climate strategy, producing its first TCFD report, conducting regular training on RI and climate change, and updating its suite of policies, such as the ISS and the risk register, to include specific reference to climate risk and how it is and will be managed. So this really demonstrates that the fund has made considerable progress in terms of its responsible investment and climate change practice. There are some further ongoing recommendations, and one additional that we have provided in this year's climate risk report, which is to a report in line with the 2020 Stewardship Code, which I do believe the fund has already indicated its intention of doing. So just moving on now to the next part of the report, the carbon risk metrics on page 21. So this method of analysis is a bottom-up analysis, and it considers Shropshire's equity investments. Unfortunately, at this point in time, data limitations and other asset classes mean it cannot really be extended beyond this. So the TCFD recommends that pension funds disclose at least the carbon footprint of a portfolio. And what we've done in this report is we looked across 4 metrics, which is the carbon footprint, the exposure to fossil fuel reserves, the exposure to clean tech, and carbon risk management. So on page 21, we can see the carbon risk metrics at the total equity level, and this includes the Magedi, the LGIM, and the Lgps Central portfolios. Just to note that this doesn't include any changes made since the 31st of March 2021, such as switching the LGIM portfolio for a low carbon benchmark. So between 2020 and 2021, so the first and the second climate risk report, Shropshire County Pension Fund's carbon footprint decreased by 9.9%. So from 147 tonnes of CO2 per $1 million of revenue to 132. So that means really on average for every $1 million worth of goods and services the companies in the portfolio sell, they now emit 9.9% less tonnes of greenhouse gases. This downward trend in the carbon footprint is observed in all the underlying portfolios. So the Magedi, the LGIM, and the Lgps Central funds all experience reductions in their carbon emissions, ranging from 5% to 26%. For the other metrics, the exposure to fossil fuels and the weight in clean tech, the fund's exposure remained largely unchanged between 2020 and 21. And this is similar to the benchmark, which also didn't change much year on year. However, Shropshire County Pension Fund does remain underweight the benchmark on fossil fuel reserves, thermal coal reserves, and weight in coal power. So really, in other words, the fund is outperforming the benchmark or kind of the general market on these metrics. So the kind of key takeaway here is that on average the results are positive, and this suggests that the fund is moving in the right direction in terms of its carbon risk management. Following on from this, in the fund's 2020 climate risk report, we recommended that Shropshire create a climate stewardship plan. Now, this is a list of companies that the fund can watch out for or ask its portfolio managers for progress on. And you can find this focus list on page 15 of the report. So it's really these companies which are influential in driving up some of the numbers from the carbon risk metrics analysis. So companies with a high carbon footprint or a high exposure to fossil fuel reserves. And the climate stewardship plan reflects the fact that it's not really possible for Shropshire to ask about climate risk with every company in the portfolio. The fund invests in thousands of companies. However, it can monitor a watch list of the companies, those which, based on the quantitative analysis, are the ones most worth pursuing a strategy of engagement with. In the 2021 Climate Risk Report, we have tracked ongoing engagements with those companies and have provided kind of an update detailing the progress that those engagements are making kind of year on year. And this climate stewardship plan also really highlights that it's not just the kind of energy companies such as Shell or BP that are responsible for carbon emissions or exposure to fossil fuel reserves. Shropshire County Pension Fund's climate stewardship plan includes companies across 5 sectors, so energy, utilities, materials, industrials and mining. And really the transition to a net zero economy is complex and needs to happen across all sectors. And I think the Glencore company is a good example of that. Glencore is one of the companies in the fund's climate stewardship plan. And just for a little bit of background, Glencore is a diversified mining company that engages in the production of and marketing of metal, minerals, energy and agricultural commodities. It is also a major coal player and miner, and the largest contributor to thermal coal exposure in the total equities portfolio. So this is why it was included in Shropshire's climate stewardship plan. Glencore also, however, mines metals and minerals that are critical within green technology, amongst others coppers, cobalt and zinc, and it does plan to increase their exposure to these to kind of meet the demand for renewables. And what we have seen is that this company, Glencore, has moved from being somewhat of a laggard among mining companies in terms of its climate ambition, and taking action in some promising steps in recent times. So in its latest AGM, the one in April 2021, it put forward a climate transition plan. And within that plan it included a net zero by 2050 target. It included a midterm 2035 50% reduction in absolute emissions target. This was initially actually set at 40%, but in response to investor pressure, they increased their ambition to a 50% reduction. They also promised better transparency around climate policy lobbying. They announced a 2026 target, which they have acknowledged falls short of 1.5, and that is still an engagement issue that we're working through with the company. And through an initiative called Climate Action 100 Plus, which covers about 180 companies responsible for 80% of industrial greenhouse gas emissions globally, Lgps Central co-leads on that engagement with Glencore, alongside Royal London AM and Northern Trust. So we did have a recent meeting with the new CEO, Gary Nagle, and within this meeting, we really pushed on setting a 2030 target, which shows the curve from 2026 to 2035. What we really want to see here is, the decarbonisation pace during this next kind of very critical decade. As I've said, we're engaging on the 2026 target. We want that to be more ambitious. And just on policy lobbying as well, we are pushing the company to kind of strengthen its commitments there. So that was just really one example of one of the engagements that's being conducted as part of the climate stewardship plan. So that really does bring us to the end of this presentation. I'm just hoping to finish up with a high-level summary of kind of the next steps for Shropshire in order to kind of progress the management of climate risks within the fund. So the fund has clearly made significant enhancements to its climate management and oversight since that first climate risk report. So as I've said, this includes publishing a climate strategy, reporting against the TCFD recommendations, updating its suite of policies, conducting regular training for the committee, and forming a climate stewardship plan. In addition, the carbon risk metrics have improved year on year and remain more efficient than the benchmark. In terms of kind of next steps, we do recommend that the fund consider reporting against the 2020 Stewardship Code and continue to report against the TCFD recommendations and the Climate Stewardship Plan. So just finally, I'd like to thank everyone very much for their time today. If there are any questions, and I think I already heard one starting earlier, we're happy to take them.
Roger, do you want to ask you a question, please?
Thank you, Chairman. I've got several questions, but if I can pick on Glencoe to start with, as that was picked out in the presentation. Going on the report, it's dated March 31st, 2021, but there's some information that's come out as after that date, so I can only refer to what's in the report before us today. And I'm disappointed for Glencoe in this report, which is the report that we are basing things on. It says a net zero by 2050 ambition across all scopes, and then for the medium target of 40%. I heard what was said in the presentation, but do we really think that an ambition is satisfactory enough? I see the others on this list: BB not aligned, Duke Energy below 2 degrees, Glencoe below 2 degrees, Holcomb not aligned, Net Extra, congratulate, pledges, Ryanair, big question mark, and then Southern Company below 2 degrees. Now, if we're looking at climate, judicial duty comes later, and I would like to just have comments about these companies not aligned with the 1.5% and climate risk, which is widely stated in many periodicals, and it was referred to in some of the questions that were here today. And I'm picking Glencoe in particular. Doesn't seem to be very committed to me in the report that's before us today. And then I've got some other questions, unless others want to come in as well, Chair.
Okay. Patrick or Laura, who would like to take this?
Shall I kick off, Laura, on that one? So I think you're right. We're not satisfied with where these companies are at this point in time, and we need to push them harder to make stronger commitments. And I think you've done well there to pick up some of the ambiguity in some of the language used by companies around this. And ambition isn't the same necessarily as a commitment or a target. And it's the same for governments as well. Governments have been quite ambiguous in terms of setting commitments and targets. Some of them have made public statements that haven't yet been put into policy and haven't yet been codified in law. So in theory, with a change of government, the commitments could change. So that is a very fundamental part of what we're engaging companies on around this. I would say that Glencore has gone on quite a significant journey from when investors first started to talk to them about climate risk. 40% by 2030 is not satisfactory, 50% is what's required, and will continue. And we're the lead engager with the Climate Action 100 group, so we're engaging with other investors that have trillions of dollars under management in total, pushing companies to accelerate their decarbonisation on this. It's interesting that they do have scope 1, 2 and 3 emissions in there, which a lot of companies don't, and that is encouraging. And that they have put a transition plan forward to their AGM for voting on by shareholders. We supported it last time, but we voted against the chairman because we didn't feel that the plan itself went far enough, and so we sent that message to the company. We'll continue to do so. But progress is being made, and it needs to accelerate.
Next question, Roger.
Thank you, Chairman. I note what is said, but in the report, I see on page 3 it says 6.23% of total equities is exposed to fossil fuel reserves, and also in the risk management on page 4 it says they are not aligned with a 1.5 degree scenario. However, all the companies are making clear progress, which is evidenced by achievement of several measures of success. Now, it all depends how one measures success. Is it now, or is it 2040 or 2050? And then if one reads the report further on, it says that in 3.2, you do mention, and I noticed it was mentioned in one of the questions, in the past 35 years, with 5 warmest years of record taking place since 2010. Now, comment was made that the 7 warmest years have been made virtually in the last 7 years. I'd like a comment on that, and I'll leave it at that at present, Chairman.
Okay, thank you, Roger. I'll come to you, Patrick or Laura.
Yeah, so with regards to Shell, with regards to the fossil fuel industry, yes, you're right. Again, there's further decarbonisation required there. The key ask of the CA100 is that these companies align their portfolios with a net zero 1.5 degree future. Now that takes time, it doesn't happen overnight. It is a transition, it needs to accelerate, we know that, and that is the ask. We very much consider ourselves owners of these companies and not speculators in the share price or short-term speculators in that sense, and that's the kind of ownership and the long-term view that's required to change these companies. Demand for their product remains robust, and we're also addressing the demand for fossil fuels through our engagements with the steel industry, the cement industry, aviation and transportation, which are key clients to the industry. We're of the view that if you only address the supply side of this problem, then you're likely to cause a spike in fuel prices. So we need to address the supply and demand at the same time. And just to reiterate, the net zero target is a 50% reduction in scope 1, 2 and 3 emissions by 2030 and net zero by 2050. They again shall put a transition plan to the AGM for voting. We voted against it because we thought it was back end loaded, so a lot of the things that they were relying on were going to happen post 2030, and we need action earlier than that, and we need to achieve that 2030 target. We need more front-ended action, and there's a certain amount of reliance on technological developments such as carbon capture and storage, which we're also very cognizant of and are concerned about in the plans of a number of companies.
Okay, thank you. If you want to, yes, Louis, yes.
Just a further follow-up, Roger, and something that Laura mentioned. When we're looking at the carbon metrics in the report, which are on page 21, it's worth mentioning, Laura mentioned it, I'm just going to bring it out a bit more. The recommendations that we're making later today in terms of the movement from the UK equity to sustainable equity, together with moving the legal and general passive to a low carbon transition, will have a material impact on these statistics next time you look at the report. We're not talking a kind of 10% drop down, we're talking a very large change in these carbon metrics. Yes.
Sorry, Chairman, can I come back on that? I noticed that on page 21, this paragraph, the exposure of the total equity portfolio to fossil fuel producers and thermal coal producers remain largely unchanged on the 31st of March in the period 31st of March 2020 to the 31st of March 2021, the total equity weight on clean technology has increased marginally. And it gives some details there, but it says that the portfolio to fossil fuel producers remains largely unchanged during that year. What you're saying is that since then it has changed or not, because that's the report that's here.
It hasn't changed since then. There is a recommendation of change that's being brought later on. So subsequent, then when that transition has taken place, subsequent to this meeting, that is when the impact will be seen in the numbers. And I would say specifically what we are targeting is the carbon footprint numbers more than anything else. I think you will see like an improvement across all the data. The carbon footprint is the specific objective of those changes.
Just to add on that point as well, I mean, that period that you've just alluded to there was a very unusual period for equity markets. There was a collapse in the price of fossil fuel shares. It wasn't a good time to sell at that point. Subsequently, there has been a recovery and the energy sector has improved, and the share price has gone up. So again, a lot of the managers are taking advantage of that upside that sector's seen. If we do go down the route, and Lgps Central is going to go down this route of managing portfolios in accordance with net zero, there will be some parameters around what fund managers have to do to make sure we achieve those targets. So a slightly different situation to the one that's prevailed over the last year and a half. Laura, do you have anything to add?
No, nothing else said.
Okay, thank you. Carolyn next, and then there's quite a flood of hands. Yes, Carolyn next, please.
Thank you. Obviously I welcome the report and the fact that there is some carbon footprint reduction. I think, Patrick, you said, ambition isn't the same as commitment, and I would say that commitment isn't the same as action. And I think that's what feels to me, obviously, and I understand this is a climate risk report, it's based on the plans that companies are putting in place. But I suppose for me, I'm trying to understand then, how does that translate into actual action? I really welcome the point you made that you're unhappy with, I think, was it Shell, I can't remember which you mentioned, that you voted against because their plan was very much back-ended, because it's very clear that we need those very swift transitions away from fossil fuels and carbon reduction very early. So I'm pleased about that, and I'm also pleased that LPGS Central isn't supportive of an over-reliance on carbon capture, because clearly all the evidence suggests that isn't going to get us out of this. So again, that's not a good strategy for these companies. But what worries me is these companies will continue on that strategy. And so I guess there's something for me about, or what is the timetable? It's okay, we can give people their green scores and their 4-star scores when they've got all their plans in place and we feel that they're good plans. But what point do we sort of, are we measuring the actual action and therefore the shift? What are the timescales for that? And at what point, if we're not satisfied that these companies are moving quick enough into that action, do we say this isn't the right place for our funds?
Yeah, I think it's worth also noting that there was a 9% reduction in the carbon footprint of the portfolio year on year, which is encouraging. That's a carbon intensity number, I believe, Laura, isn't it, rather than an absolute emissions number. So you do have to kind of dip into that a bit more to understand what's driving that. But that is an encouraging number. The net fleet target is 7.6% decarbonisation year on year to achieve 50% reduction by 2030. So there is some encouraging signs there in terms of the portfolio itself. Currently, there are no targets in place around any of the mandates within the Lgps Central pool. Now, if we commit, and we have committed to net zero, that does put some parameters around how they're going to manage our portfolios. And then that does create a conversation down the line as to, well, we need to achieve this alignment, and if there are companies in the portfolio that are detracting from that, and they're showing no signs or an inability to be able to transition to a net zero future, then that's a conversation that's very strongly worded around divestment. So once we have that position in those portfolios, that then makes the maths and the conversation much more clear.
Okay, thank you. Brian, then Simon, and Ray, did you want to speak? No, it's Brian and then Simon, please.
Thank you, Chairman.
Thank you, Chairman. It seems to me, Chairman, that we can discuss ad infinitum the individual figures within the report, individual timescales. We can look at certain companies. We've looked at what we're told are the 8 worst polluters among those companies in whom we invest. I would rather look at this report as a whole, and it would seem to me that it gives assurance that we as a committee are moving in the right direction. I look at page 3, the headline, the executive summary. 9.9% carbon reduction in total equities portfolio since March 2021, which is less than a year gone by. All underlying portfolios more carbon efficient than their benchmarks. For some people, we're not moving fast enough. For others, in terms of our financial strategy as distinct from our climate strategy, we might be moving too fast. We can discuss ad infinitum and all have our own individual opinions as to whether we're going fast enough, whether we're doing sufficient. But in overall terms, and in accordance with our responsibility, overall financial responsibility to those who are our pensioners, when I look at this report, it seems to me that we've got our strategy right, that we are moving in the right direction at as reasonable a pace as is possible to ensure that the scheme's financial management is satisfactory. And in those circumstances, Chairman, I'm prepared to accept the report. And when you want to take a resolution, or I'll make the resolution now, and you can put it on one side, or when you decide that the matter that we've had enough discussion, I will move acceptance of this County Pension Fund 2021 Climate Risk Report.
Okay, it's actually a presentation rather than to be agreed or noted, so we don't actually have a recommendation. But thank you very much for the offer. And Simon, and then Byron. Simon.
Sorry, Councillor Biggins, sorry to interrupt. Can you just use your microphone?
Oh, sorry.
So tell a message.
Thank you, Mark. Here we go. Simon next, please, and then Byron.
Yeah, thank you, Chair. First of all, I'd like to thank Councillor Evans for picking up on Glencore, not Glencoe. It's a place in Scotland. But Glencore actually has quite a history, and I'd like to thank Lgps for focusing on Glencore, and I would really encourage you to continue to do so and keep coming back to us on Glencore. I do have one question on the metric of this 9.9% carbon reduction, because as you said, it's carbon reduction based, I think, on dollar revenue, so it's how much have they reduced as per how much more have they sold. I'm not sure. While I understand that that is a widely accepted way of measuring carbon reduction, I, for one, am more interested in the absolute, because this 9.9% actually could suggest that even though it's good according to this metric, you've actually put more carbon CO2 tonnage into the atmosphere. And I would encourage Lgps to actually use a different absolute metric when we're reporting back 6 months, hopefully, or whenever you're going to report back. Thank you.
Patrick, and
I agree with you. I think absolute emissions are a very important metric to analyse as well. But they don't necessarily reflect what's happened with an individual company, i.e. there's lots of mergers and acquisitions going on. If a company's business model grows, the company becomes larger, it's becoming, there's more demand for its product, and its throughput is as high, its emissions are going to go up. So it's important, I think, to understand and analyse both metrics in conjunction, both when looking at the individual companies and the portfolio as a whole, to understand the full story of what's going on. It is an important metric as well in terms of understanding the efficiency of a company. So how efficient are they in terms of their processes. We want to compare companies to their peer group. So we want to understand who the leaders, who the laggards are, who the efficient ones are, who the inefficient ones are, and the intensity metric helps with that as well. So I think with carbon intensity metrics, it's important to use more than one, because they all kind of tell you slightly different things.
That's Patrick. So I don't disagree with that for a moment, and thank you for the explanation. But I do think we ought to be looking at both when we've got the headline figure. That's all.
Okay, thank you. And Byron, please.
Hi, right, just listening to the report and reading through it, and sort of following on what Brian said, as a pensions committee, yes, we have a responsibility to ensure that money is invested and we get a good return. But as a pensions committee as well, we also have a responsibility to the people who invest in our pensions. Now, from my point of view, as an employee representative, that's the employees, that people such as IT in the back, people here who are working, who pay into the pensions fund. Now they're going to ask the questions, well, why did you invest in someone that's not good for the environment, that's not being as active? 2030 for half is not great, even if you're having to push it. And also, sort of another thing I like to bring your attention to, and something to think about, is technology, and technology moves so fast, and inventions. If you think 10 years ago, only 50% of the population of the UK had a smartphone. Now, I can guarantee you everyone, or most people in this room, will have a smartphone. So what's it going to be in another 10 years' time? And that goes for green energy. At the minute, you know, it is there, it's usable, it's improving. What's it going to be like in 10 years' time? And I just worry that I'm going to sit there when I'm retired saying to my children, well, we didn't invest in this company that's made a fortune. So I think we need to sort of broaden our horizons a bit and just be aware of the people that we have responsibility to, both working and retired. All right, thank you.
Okay.
Can I just respond to that? I mean, 50% reduction by 2030 is actually quite a huge undertaking for these companies, particularly if you base it on their scope 1, 2 and 3 emissions. So we're asking, with scope 3 emissions, we're asking them to take responsibility for their product in use, and really how their customer base uses their product. So that is quite a big ask. It is also in line with the IEA scenarios, the IPCC reports, and the commitments that were made at Paris and reaffirmed at Glasgow. So that is the trajectory. It varies from sector to sector. Like, for example, utilities need to get there by 2040, other sectors a bit later. So it is aligned, and it is a huge challenge. And I totally agree with you on technology, and that's fundamentally what our fund managers are tasked with doing, is finding those opportunities and investing in them, identifying the risks associated with environmental, social and governance issues, and making sure they manage those in the portfolio, take those into consideration in their investment processes, and make sure the portfolios are tilted appropriately for future returns. And in many respects, they're the best qualified people to do that, the analysts that cover the sectors. There are opportunities in renewables, but there's not enough. There's a lot of money chasing those opportunities. Some of the valuations aren't as attractive as they might have been a few years ago. And a lot of the technology that you allude to is currently with venture capital and startups, which is very risky. Now, in some respects, if you want to play those technologies and those technological developments, one way to do it is by investing through large corporations who are investing in this transition through their R&D budgets, and they're transitioning away from their traditional business models to future business models that are better suited to a low carbon economy. And that's really is the fundamental strategy of those people that are managing the assets on behalf of Lgps Central.
Last question from Roger. I think you wanted to ask one more question.
Thank you, Chairman. I'd like to hear views. I note that there are a number of MPs in Parliament calling for disinvestment from fossil fuels. But also Also, it's been reported in the press that EU's biggest pension fund is to, and I'll use the headline that's in this article, EU's biggest pension fund to dump $17 billion worth in fossil fuels. And it goes on to say that ABP will divest 15 billion euros, $17.4 billion worth of fossil fuel assets by early 2023. The fund said it doesn't expect the decision to hurt long-term returns and added that the move will allow it to unveil a more ambitious CO2 reduction goal next year. Mike, any comments on ABP's position that they say if they divest from fossil fuel companies, it will not affect their return? Thank you.
Yeah, our position is that the way to manage this transition and the risks associated with it is to analyse companies and sectors on a case-by-case basis. The profile of gas is very different to the profile of coal. If you're concerned about the risk of stranded assets, then that varies from company to company, depending on where those assets sit on the cost curve, how carbon intensive they are in terms of the scope 1 and 2 emissions required to extract those assets. And managing that on a case-by-case basis over the transition and in line with net zero is the most logical and safest way a nuanced way to approach this. Now, ABP, I believe, managed most of its money in-house, so that's a slightly different scenario as well in terms of adopting the strategy. Our external managers invariably are not advocating this, nor do they seem to, nor is it a strategy that they're adopting in their own processes. Now, I'd like to look into more detail about exactly how they plan to do it, how they define fossil fuels. For example, if we were to look at utility sector, NextEra, for example, is a very carbon intensive company that appears on your report, but it's also the largest provider of electricity via renewable energy in the world. Currently still reliant on gas, which gives them their carbon intensity. Now, they are transitioning away from gas, but as I said, they're one of the biggest clients for renewable energy on the planet. So does it make logical sense, either on an ethical, moral or financial basis, to divest from them? I think it's better to analyse the company itself and its risk profile and its balance sheet and understand specific to that company, make a decision on that basis. And equally across coal, Glencore's company we discussed today, they get 4% of their revenue from coal currently, from thermal coal, and have exposure to cobalt, nickel, zinc, and a number of other minerals that are positively positioned for the transition. So again, would a divestment from fossil fuels require you to divest from Glencore on the basis that they get 4% of revenue from thermal coal? So again, how you implement this, there's a lot of nuance and a lot of decisions to be made. And I'm not sure how at this point in time you could guarantee that that decision won't be financially detrimental.
Okay, well, I did say that I was going to be the last, but go on.
Another question just to come back on that. I mean, some pension funds that have divested have used, exactly, you're quite right, Patrick, clearly companies have a breadth. These are big companies, they have a huge range, products, services that they provide, lots of subsidiaries and so on. But I think, and I haven't got the percentages, so I haven't got any internet in this room, so I can't look it up. But certainly, I think the pension funds that have divested have used a percentage mark. So if an overall company's, revenues of above a certain percentage come from fossil fuels, then it's in scope for divestment. If it's below, because they're doing other things that can be very positive, as you suggested, then we stick with them and continue that engagement process. So I think there are ways. It's not black or white, is what I'm trying to say. There are ways around that. I think it'd be good, perhaps in future, to explore some of those things.
And what I would say, if you delve into some of these commitments, they set their threshold from thermal coal at 20%, which would still allow you to invest in BHP, Glencore, Anglo American, Rio Tinto, pretty much the whole of the integrated miners and the biggest part of the thermal coal market on the planet. So I agree with you entirely. You've got to look, when you look at these fossil fuel divestment commitments, where they're setting their thresholds, how they're doing it, because it doesn't all kind of stack up in terms of a complete step away from that industry at all.
Okay, thank you very much. Well, in that case, I think that's been a very useful paper. We'll now move on to. Oh, sorry, beg your pardon. We'll now move on to agenda item 9, the council motion. We have a number of reports. I think what we'll do is we'll run through the reports. Justin will introduce the paper, and then we've got reports from Aon, Lgps, LGIM, BMO, Roger Barkley, and a government statement as well. So what I'm going to suggest we do, if you're happy with this, members, we run through each of the reports. If there is anything specific to that particular report when it comes up that you want to ask a question, by all means, please do. But what I'm proposing that we do is we hold off the main debate until we've got through the reports, and then we've got the recommendations, and if there happen to be any amendments or whatever, we can take those then. It's just really to get an orderly pathway through the process. So I'll ask Justin, please, to introduce the paper.
Thank you, Chair. So we've discussed a lot about this already today with the climate risk report and all the questions we've received. So I'll just provide a high-level summary, really what's in the council motion report. So the report goes into all the significant training that the committee has undertaken since the council motion was passed in 2020. So we've been on a journey over the last 18 months on climate-related issues, which members have had training on. We've had our second climate risk report that we've just heard. We are one of the first Lgps funds in the country to produce these climate risk reports. We've also produced our public TCFD report, again, one of the first Lgps funds in the country to do that. And we've implemented, in accordance with the summary of the report, 94% of those recommendations. So we've made significant progress over the last 12 months and will continue to make significant progress on these important issues. We can also see from the report a large proportion of our equities are already invested in clean technology, 36% in total. So that is, a positive start. Paragraph 13.1 of the report lists in detail all the presentations we've had since the council motion in July 2020. All the companies that have done the presentations. There's been public chair statements, all the details of public questions submitted, and all the answers are on our public website. And members have also been on specific webinars themselves on climate related issues, and the Lgps Central have run a full day back in October 2021 when all pension committee members and all pension board members attended, which was a full day event, and there was a number of public and private sector responsible investment experts that delivered the training on that day. So another thing, one of the first in the country to do this, we've got our own separate climate strategy and stewardship plan for the pension fund. And a number of other comments that have been made in questions today about, obviously, the pension fund value goes up and down all the time. And there's lots of questions about individuals' pensions members. They are not impacted by the fund going up and down. It's a local government pension scheme. It's a defined benefit scheme. It's based on their individual salaries and their years of service, not the value of the entire fund going up and down. So now there's a number of appendices with the report. I'm going to ask industry experts to present on this. So start off with Aon, who's our investment consultant. We've also got Lgps Central you've heard from. We've got Legal in General, who run a big proportion of our passive equities. And then BMO. And then, as the chair said, Roger Barkley, our independent advisor, will summarise all those views. And then I'll hand over to James Walton, the Executive Director of Resources, Just to summarise the governance arrangements for all members sitting on this pensions committee before handing back to the chair to go through the recommendations. So on that point, unless there's any questions on the actual report, I plan to hand over to Louis from Aon to run through their public net zero statement.
My name is Louis Hill. I'm investment consultant to the fund. I work at Aon. Aon, as Shropshire County Pension Fund's investment advisor, recommends that adopting a net zero carbon emissions by 2050 or sooner target is appropriate for the Shropshire County Pension Fund. A number of climate-related targets have been considered for the fund, including no investments in fossil fuels by 2022. And setting a net zero carbon emissions target by 2050 or sooner. We believe setting a net zero target is the most appropriate as a means of decarbonising the fund's investment strategy, managing climate risk, and ensuring that the fund keeps pace with the transition to a low carbon economy. This is for the following 4 reasons. Firstly, net zero goes beyond emissions from fossil fuel production alone. Divestment does not resolve the issue of emissions from the end users of fossil fuels. In other words, it does not reduce the demand for fossil fuels from other companies who themselves have significant carbon emissions that need to be reduced. Sectors such as utilities, industrials and materials are some of the largest consumers of fossil fuels globally. According to the fund's climate risk analysis, many of the largest emitting companies are within the utility sector rather than being fossil fuel production companies. By progressing with divestment from fossil fuels alone, these sectors would be neglected despite their relatively high carbon emissions. Setting a net zero target would see the fund's asset managers engage with all high emitting companies, including and beyond fossil fuel companies, to reduce their carbon footprint. This should result in an overall reduction in demand for fossil fuels, which is key to mitigating the overall climate risk to the fund's assets and the planet's overall warming pathway. The other 3 reasons I'll just highlight. Secondly, net zero aligns with Lgps Central's approach to implementing the fund's investment strategy. Secondly, net zero aligns with global industry standards. And fourthly, net zero allows the fund to retain influence to engage and encourage positive change from the highest emitters. In conclusion, Aon recommends that adopting a net zero carbon emissions by 2050 or sooner target is an effective and thorough way for the Shropshire County Pension Fund to manage climate risk. I'd also like to highlight the 5 recommended next steps. Firstly, that the fund should put in place short and medium-term plans to make progress to the net zero by 2050 or sooner target. Secondly, the fund should transition out of its UK equity allocation and invest with the global sustainable equity managers with Lgps Central. Thirdly, the fund should transition out of its passive FTSE developed index allocation with Legal & General and invest in the sole active Legal & General Low Carbon Transition Global Index. This new passive benchmark will deliver meaningful carbon exposure reduction and a positive tilt towards companies with green revenues. Fourthly, the fund should continue to work with Lgps Central to put in place the net zero target and short and medium term plans. And finally, the fund should continue to implement climate stewardship activity, including conveying policies and targets to stakeholders. Thank you.
Okay, any questions on that? No, very good. Well, we'll now move over to Lgps, please, and Patrick again. Thank you.
Thank you. The next decade is going to be critical in the fight against climate change. Humanity is running out of time in terms of implementing a consistent and coherent strategy to limit climate change. The required decarbonisation trajectory of the real economy becomes steeper and steeper with each passing year, and as a result, the role of pension schemes as owners of the real economy is becoming increasingly critical. Lgps Central recognises the importance of aligning investment portfolios with the targets set at Paris and affirmed in Glasgow, and as such has recently committed to achieving net zero alignment in our investment portfolios by 2050 and adopting interim targets in accordance with the Institutional Investor Group on Climate Change Net Zero Investment Framework. Lgps Central was amongst the original group of asset owners that worked with the IIGCC to develop the framework by the Paris Aligned Investment Initiative working groups. The framework has been adopted by asset owners and asset managers as a framework for alignment with the goals set at Paris. Lgps Central has been a sponsor of the Transition Pathway Initiative, TPI, since its inception, and is now a founder and director of the newly established TPI Limited, which has resulted in the development of an open access analytical tool used by investors across the globe to assess the decarbonisation of companies, sectors, benchmarks and investment portfolios. The TPI is a framework that's been used for portfolio alignment and investor engagement by many asset owners and asset managers. It is a critical tool for the measurement and reporting of alignment, and Lgps Central remains at the core of its evolution. Lgps Central considers net zero alignment to be a fundamental strategy for responsible investment during this unprecedented period of disruption and transition. It is a strategy that is consistent with our conviction that the integration of ESG considerations, that's environmental, social and governance considerations, into investment processes supported by a robust programme of corporate engagement is essential to the delivery of our fiduciary responsibilities. We consider that it is the strategy that is most likely to maximise our contribution to this critical transition and lead to the best outcomes for our members and society as a whole. Investors that proactively integrate ESG considerations into their investment processes and commit to net zero alignment will inevitably invest in those companies that can and will transition and avoid those companies that can't and won't. This is the most enduring way to impact corporate valuations and thus incentivise responsible corporate behaviour. A net zero alignment strategy affords Lgps Central an opportunity to play its role in accelerating the transition through the exercise of stewardship rights associated with corporate ownership. Lgps Central scrutinises and challenges companies and their management on climate strategy and is part of investor collaborations that put forward increasingly ambitious demands in this regard. Our in-house team of ESG specialists can measure net zero alignment at portfolio and company level against agreed and established sector level decarbonisation pathways. These insights enable the team to develop and deliver a programme of engagements focused on accelerating net zero alignment where it is lacking. We are also in a position to monitor and challenge our external managers on the delivery of their engagement programme. COP26 highlighted that there remains much work to be done if we are to avoid the worst effects of climate change and limit global warming to anything near 1.5 degrees centigrade. It is not going to be easy. The achievement of net zero requires the honest and accurate reporting of carbon emissions at corporate and government level, and will inevitably require transparent and responsible usage of offsetting mechanisms. Unfortunately, not all industries will reach gross zero emissions. Investors must act as responsible owners of the companies in which we invest and be demanding around the setting and achievement of net zero targets. The next 10 years are going to be critical, and investors must play their part in scrutinising and challenging management. Companies cannot and will not transition at the pace required without the support and influence of their shareholders. It is the responsible investment community that will take a long-term view of corporate performance. As universal owners of equity, we can focus on both the demand for and supply of fossil fuels in our engagements. The primary objective of the IIGCC Net Zero Framework is to ensure investors can decarbonise investment portfolios and increase investment in climate solutions in a way that is consistent with a 1.5 degree net zero emissions future. An investment strategy-led approach supported by concrete targets set at portfolio and asset level, combined with smart capital allocation and engagement and advocacy activity, ensures investors can maximise their impact in driving real-world decarbonisation. 4 different asset classes, sovereign bonds, listed equities, corporate fixed income, and real estate are covered by the framework, with others to follow. Other features include: the framework focuses initially on 4 asset classes: equity, corporate fixed income, sovereign debt, and real estate. The framework focuses on emissions in material sectors to maximise impact. Commitment to aligning investment strategy with achievement of global net zero emissions by 2050 at the latest. establishment of medium-term emissions reduction targets consistent with the 2050 target above, 50% reduction in carbon intensity by 2030 at the latest. Portfolio alignment targets, 70% of emissions in material sectors to be either net zero or aligned to a net zero pathway or subject of direct or collective engagement and stewardship actions. Targets would increase to 100%. Increasing investment in climate solutions that are needed to meet that goal, such as renewable energy, low carbon buildings and energy efficient technologies. Targets reviewed at least every 5 years, annual disclosure of performance similar to TCFD. So how can Lgps Central help and support Shropshire County Pension Fund? So we can help with the measurement of net zero alignment at company and portfolio level, targeted engagement based on alignment of portfolios and individual companies based on their sector pathways, engagement with regulators, policymakers and government, measurement and achievement of 70% target moving to 100%, engagement with corporations supported by active voting including shareholder resolutions, ESG integration in active portfolios to help identify winners and losers, climate risk monitoring service updated for net zero commitments, TCFD reporting including future enhancements, benchmark construction and selection for passive mandates, collaborative engagement with private market industry to improve climate data collection and reporting, collaborative engagement to ensure transparent and responsible use of carbon offsets by investee companies, and accurate and holistic carbon emissions reporting. The net zero strategy set out by IIGCC aligns with the goals of the Paris Agreement, the policy and legislative aims of the UK Government and the Intergovernmental Panel on Climate Change's Special Report on Global Warming of 1.5 degrees C. It lays out the key initial steps to deliver portfolio decarbonisation while remaining mindful of fiduciary responsibilities. Such a commitment would align Shropshire County Pension Fund with the asset owner community and governments globally. The Net Zero Asset Owner Alliance has grown to 60 investors, representing 10 trillion of assets under management. The Net Zero Asset Managers Initiative now has 220 signatories, 57 trillion of assets under management. Thank you.
Okay, thank you. Any questions, please? No. Okay, well, we'll move on in that case to Elgin, and James and Jeanette will take us through this paper. Thank you.
Thank you very much for the opportunity to speak today. At Legal & General Investment Management, we believe that well-governed companies that manage all stakeholders, including the environment, are more likely to deliver sustainable long-term returns. We view the consideration of environmental, social and governance (ESG) issues as part of risk management, and therefore part of our fiduciary duty to our clients. As one of the world's largest asset managers with a long history of corporate engagement on the most material long-term issues, we aim to use our scale and voice to make real positive impact on the companies and markets in which we invest, as well as on society as a whole. Climate change is one of the greatest systemic risks we face today, and achieving net zero by 2050 will be crucial in helping steer the world towards a more certain future. We have the opportunity to use our influence to help achieve the transition to net zero, while also producing positive, sustainable economic and environmental returns for our clients. As a signatory to the Net Zero Asset Manager Initiative, we have committed to work in partnership with our asset owner clients on their decarbonisation goals. We have put in place an interim net zero asset under management target of 70% by 2030. Managing climate risk, delivering on our net zero commitments and helping our clients deliver on theirs requires working collaboratively across multiple internal and external stakeholders. Offering net zero aligned investment products and engaging with investee companies are both two core components of our strategy. Drawing on industry best practice, we have therefore set out our key requirements for a fund or investment portfolio to be considered net zero aligned. However, to deliver diversified investment portfolios and to reach the end goal of a net zero economy, decarbonising the real economy is essential. This means achieving emissions reductions across the sectors and companies in which we invest. It is why the net zero challenge is broader than the exclusion of high emitting sectors. All companies generate some emissions, either directly through their operations or indirectly through their value chain. Some high emitting companies will have an important role in developing and investing in solutions. While select exclusions do have a role to play, unilaterally divesting holdings is therefore not guaranteed to lead to the decarbonisation of the real economy, and indeed could impede necessary investment in climate solutions. The Legal and General Low Carbon Transition Developed Equity Index Fund is designed for investors seeking growth from equity indices with a similar risk profile, whilst also aiming to reduce the carbon emissions intensity by roughly 70% compared with the relevant market cap benchmark. The funds also seek to achieve significant decarbonisation over time to reach the goal of net zero carbon emissions by 2050. However, the funds go further than just congratulating the companies with the strongest climate-friendly credentials. The scores that feed into the underlying index design are generated from a range of information and data that are directly aligned with our engagement and voting activities. They are also public, creating a powerful incentive for the investee companies to improve their behaviour. Engagement with investee companies to achieve real economy emissions reduction is critical. As a firm, we are recognised for using our scale and weight of our votes in advocacy and engaging with policymakers, regulators and companies on climate change. We have a long-standing climate engagement programme, the Climate Impact Pledge, which is now approaching its 6th year. We are systematically holding companies across 15 climate critical sectors accountable through our votes and targeted divestment decisions on their climate ambitions and disclosures. Our aim is to encourage companies to align their business to a net zero emissions trajectory in line with the 1.5 degrees Celsius target, and we vote against and divest those that fall behind. Last year, approximately 150 companies were sanctioned through a vote, and 13 went on to be subject to divestment in certain funds. Through this targeted engagement programme, we have been able to affect real change and help steer companies towards better practices, including reducing carbon emissions. Financial institutions and companies need to play their part in driving down global emissions and redirecting the capital flowing through the global economy towards a 1.5 degree world. That is why we are demanding the companies in which we invest to meet those minimum standards on climate issues. In order to reach net zero, we are not committing to a large-scale divestment across all of our funds. As a firm, our house view is that engaging with companies leads to better outcomes for clients and the market as a whole. Through our approach in investment stewardship, we seek to improve companies' standards by engaging with them and using our voice. However, when combined with engagement and voting, the targeted exclusions can also be a very powerful tool, such as the exclusions applied through our Climate Impact Pledge and implemented in the Legal and General Low Carbon Transition Funds. Additionally, for certain activities where engagement is considered to provide limited scope for change, where such activities present investment risk, or where they where companies are in breach of international conventions and treaties, we may apply company-wide exclusions. We will continue to advocate for policies towards a more sustainable economy, including working with and holding to account companies, regulators and policies, including the UK government, to support our commitments to net zero and the outcomes of globally agreed commitments, including most recently at the COP26 climate conference in Glasgow. Thank you.
Thank you very much. Any questions? No? Okay, well, we'll move on to the next paper, which is from BMO, and I believe Alan is going to present this to us. Over to you, Alan. Thank you.
Thank you, Chair. Good morning, ladies and gentlemen. BMO Global Asset Management, part of Columbia Threadneedle Investments, has been the engagement provider to Shropshire County Pension Fund since 2005. We engage companies held by the fund, calling on them to improve their policies and practices on a range of environmental, social and governance issues. And whilst the engagement covers a wide range of ESG themes, climate change has consistently been a high priority, and this has been guided by the preferences of our clients. In our view, and having conducted a shareholder engagement program for over 20 years, engagement, if it's done in the right way, can be a very powerful lever for change at companies. Divestment strategies remove the opportunity to use this influence as a force for positive change. On behalf of the Shropshire County Pension Fund and other engagement clients, we engage with companies across sectors and regions, encouraging them to adopt business strategies which are consistent with a net zero emissions economy and with limiting the global temperature rise to 1.5 degrees centigrade. But our engagement goes well beyond asking companies just to set a net zero target. Our asks also include setting interim targets, such as including ambitious 2030 targets, to publish a transition strategy, to operate appropriate governance structures, and indeed disclose in line with the TCFD recommendations. For specific sectors, we may have additional asks or recommendations, such as calling on banks to integrate climate change into lending and underwriting policies. We have expectations of fossil fuel companies, and there are particular considerations and expectations that we apply to the likes of coal miners and oil and gas companies. Our engagement puts product emissions at the centre of the dialogue, where we push for phase out or managed decline of fossil fuel production in line with the sectoral standards referenced earlier, and indeed in line with net zero pathways produced by, for instance, the International Energy Agency. Where possible, we aim to engage directly with the boards and senior management of companies to have maximum influence and to emphasize the fact that ESG issues, including climate change, should be considered as core to business strategies. And indeed, for the largest emitters, we engage collaboratively through Climate Action 100+, which has been referenced previously. The principles behind this initiative are indeed aligned with our own, and with $60 trillion represented, the weight of assets means that we can get good access to companies and begin influencing them for change. We are systematic in recording our asks of companies and whether these are indeed successful. Where a company changes its policies or practice following our engagement, this is recorded as a milestone. We recorded 283 milestones for Shropshire County Pension Fund in 2021, 78 of which related to the issue of climate change. In the case of fossil fuel producers, we see the current picture as follows. All European oil and gas majors have now adopted a net zero emissions target. However, speeds of implementation vary, with some firms planning to increase oil and gas volumes through the 2020s before cutting later, And we see this as inefficient and will engage on that issue. Diversified miners are generally shifting out of coal, with the largest firms in the sector either already divested or committed to doing so. Engagement is challenging with some companies, such as smaller oil and gas firms or pure play coal miners. Often, these companies lack the know-how and or the resources to diversify into entirely different business areas, meaning the best option for shareholders might be a managed decline. And across sectors, engagement on topics, including disclosure in line with the TCFD reporting and governance, has generally been productive. Clearly, disclosure alone is not sufficient, but it does allow investors to better analyze risk and the relative position of different companies. And whilst companies are facing multiple influences to take action, not least regulatory change, we know from our own interactions with companies that investor engagement is without doubt putting pressure on the boards and senior management level to take action more rapidly and with more ambition than would otherwise be the case. And so by using a pooled engagement service that represents over £700 billion in assets, Shropshire County Pension Fund is able to leverage its own influence and be part of this pressure to further and faster change in line with its investment beliefs. Thank you.
Thank you, Alan, for that. Yes, Simon.
Yeah, thank you, Chair. It's a quick one. Reading the appendix and listening to what you've been saying, the engagement strategy, it really is very encouraging. My problem is I don't see any measurement of how much in absolute terms the engagement strategy has meant, or indeed will mean in the future, reduce carbon in carbon emissions. I wonder if you could comment on that and what changes you'll make going forward.
Thank you for the question. Absolutely, it's currently not a metric we currently provide. We use our own measuring system. However, we do put a great deal of emphasis on transparency in our reporting to Shropshire County Pension Fund and other clients. We, as an asset manager, have committed to the Net Zero Asset Managers Initiative and therefore are analysing our own investments and the metrics we use to report on our own commitments. We are taking the learnings from this and applying it to the engagement service, which will, in the near future, allow clients of our engagement service to take those own metrics and report in real terms what the reduction through our own engagement work looks like. But it's a work in progress.
Can I possibly respond to that as well? I think the answer to your question becomes much clearer in a kind of net zero strategy, because you will essentially work out which companies in the portfolio are the most carbon intensive, and we know what they are. We'll have targets for those companies, i.e. what do they need to do to get on a net zero pathway. And that becomes the focus of our engagement, and we can measure a report against their progress as well as our progress with the engagement, what that means for the decarbonisation of the portfolio. So I think that reporting mechanism does become much easier under a net zero framework.
Okay. Thank you. Any other questions? No. Well, in that case, we'll move on to Roger Barkley, our independent advisor, please. Over to you, Roger.
Thank you, Chair. Good morning, everyone. My name is Roger Barkley. I've been an independent advisor to the fund now for several years. So let me try and summarise what we've heard this morning. There's been some very, very interesting discussion and debate. So we heard earlier how the fund had made considerable progress in enhancing its responsible investment in climate change practice over the course of the last 15 months. An example has been the reduction in the carbon footprint of the equity exposure by 10% in the year to March 21. It was also encouraging to learn that the fund's approach to RI, including climate change risk management, is judged to be above industry standards and significantly in excess of the regulatory minimum. We also heard a strong recommendation from the fund's advisor, Aon, that members approve a net carbon zero emissions commitment by 2050 or earlier, and importantly, and very importantly, put in place short and medium term plans to achieve this. I do think that we all understand the importance of actions over the next 3 to 4 years. So as part of these plans, the recommendation that members agree to commit 130 million to the Lgps Central Sustainable Equities Fund, and to note the decision to move circa 700 million to the LGIM Low Carbon Net Zero Passive Funds. These are material moves and will reduce carbon emissions by a large amount. We're talking here about circa, I would guess, about 40% of the fund's assets. We also heard from BMO, the engagement provider to the fund since 2005, how engagement can be a very powerful lever for change at companies. And I was encouraged to see that BMO is systematic in recording asks of companies and whether these are successful. So where a company changes its policies or practices following an engagement, this is recorded as a milestone. 78 relating to climate change were achieved for the fund in 2021. And finally, we heard from LGIM that net zero challenge is broader than merely excluding high emitting sectors. All companies generate some emissions either directly through their operations or indirectly through their value chain. Some high emitting companies will have an important role in developing and investing in solutions. As a firm, their view is that engaging with the companies leads to better outcome for clients and the market as a whole. However, they recognise, and I think this is very important, that combined with engagement and voting, targeted exclusions can also be very powerful, such as implemented in the fund we discussed earlier. And they concluded by saying that without further policy measures, investors unilaterally divesting holdings are unlikely to contribute to the decarbonisation of the real economy. And a final word on the energy transition curve. We had some interesting questions through the morning. In my personal view, the energy transition curve is very complex. It's probably one of the most difficult investment issues at this moment in time. I personally find it surprising that an entity such as ABP can make the assertions that were made. I think that sort of implies a degree of insight which frankly I've not seen from anyone. I think that we at Shropshire, we employ investment managers and advisors who are very knowledgeable. These managers have delivered in the past. So my feeling is that we should monitor them, we should closely question them, but we shouldn't second guess them. Thank you.
Thank you, Roger, very much. Roger Evans, a question. Yes.
Thank you, Chairman. On the statement that's been issued here, I pick out 2 sentences and would like to comment on them. On page 37 of the report, it says here, duty of elected members under general public law principles to make
we're coming to that in a minute. We haven't actually yet got there. That's the next piece.
I thought that was the one because it refers to Roger. Yeah, okay.
No. This is a verbal report in between.
Okay.
I did give you the menu listing earlier on. So yes, James Walton government statement will be coming up next. Yeah. Any other questions for Roger Barkley? No? Okay, well, over to James, please, for the statement from Executive Director of Resources.
Thank you, Chair. So I think it is important, following all those statements and the summary there from Roger, that it's important to remind members of the decisions that need to be taken in relation to these items. So I'll read out the statements in the pack. Just to confirm that. So it's important that members of the Pension Committee fully understand their responsibilities and the remit of their decision making in relation to pension fund business. Pensions Committee is a committee of Shropshire Council, in that it is administered by the Council and agendas and minutes are reported on through its website. The Pensions Committee is not, however, overseen by full Council, but rather it is an independent decision-making body in that sense. The members that sit on the Pensions Committee, whether they are Shropshire Council members, Telford and Wrekin Council members, or other members without voting rights, do not sit there to represent their organisations. They must comply with general legal principles governing the administration of scheme investments and must consider the needs of over 50,000 pension fund members and 160 pension fund employers only. Pensions Committee members have previously agreed the strategic asset allocation of the pension fund in March 2021 and the updated investment strategy statement in September 2021, and decisions must be made in the context of those decisions. When preparing and maintaining investment strategy statements, the relevant Secretary of State guidance must be taken into account further to Regulation 7 of the Local Government Pension Scheme, Management and Investment of Funds Regulations 2016. The guidance identifies the need to make investment decisions within the prudential framework and acknowledges the duty of elected members under general public law principles to make investment decisions in the best long-term interest of scheme beneficiaries and taxpayers. Regulation 7 states that the investment strategy needs to include the authority's policy on how social, environmental and corporate governance considerations are taken into account in the selection, non-selection, retention and realisation of investments. The guidance expands on what it should cover and considerations to be taken into account. This is included at the end of the written statement appended to the report. I'm not going to read that part out. It's also important to remember that the decisions taken by the Pensions Committee have huge reputational and financial risks associated with them. To this end, the Council employs Aon as our investment advisor and Roger Barkley as our independent advisor to provide advice to the Pensions Committee in the decisions that they take. To provide protection to Pensions Committee members, strong and robust governance arrangements are placed around the decision-making process. So as an example, the manager selection processes require significant due diligence to be undertaken within an approved framework in line with the agreed investment strategy before any consideration is made by the Pensions Committee. Any final selection left to the committee is then based on preference or strategic fit from a choice of managers that have all been thoroughly assessed as effectively equally competent. This concept is essential as the decision making in relation to performance then lies with the selected manager. Should pension committee members seek to guide the decision making of the managers themselves, this could transfer risk from the agreed governance processes directly to the pensions committee members. By extension, through the should the pension fund then perform poorly, and this resulted in significant financial detriment and the potential for increased employer contributions, this could be directly attributable to pension committee members taking unreasonable responsibility for investment decisions outside of the agreed governance process. There are two distinct but not mutually exclusive priorities to focus on. What more can the pension fund do to help the planet meet its climate change targets? And how can pension fund investments help ensure it is fully funded with stable contribution rates for employers? Questions for pension committee members to consider are: is there strong evidence to suggest the council motion actively delivers either of these priorities? Could the council motion actively work against both these priorities? Does a decision to divest unreasonably transfer investment risk decision making directly to pension committee members? And are there other options the pensions committee have explored in training over the last 18 months and heard today that could potentially fulfil these priorities? Thank you, Chair.
Okay, thank you very much for that. Well, we're now back to the. Sorry, I beg your pardon. Questions. Roger, do you have a question for James?
Yes, please, Jim. One comment, if I can, to start. We've been going there for 2 hours. I think in other meetings we've actually adjourned for a few minutes every 2 hours.
Thank you, Roger. I'll second that.
Well, you may want. So, if I can ask these questions, and then before the debate, maybe. Yeah, okay. My question is, Chairman, that on page 37, and not to see the comment there, is that it
highlight in the paragraph here the duty of elected members under general public law principle to make investment decisions in the best long-term interest of scheme beneficiaries and taxpayers. And then over the page, on page 39, in a section James didn't read out, but it's in the report, it says, would not involve significant risk of financial detriment to the scheme, and where they have good reason to think that scheme members would support their decision. Comment on those two statements, please, Chairman.
Okay, whereabouts is the second comment,
It's in the second paragraph on page 39, the last part of that paragraph.
Okay, thank you very much.
Okay.
Just trying to find it. Yeah, I've got it.
Okay, James. Okay, I think the principle is set out in relation to the parts that I read out. So fundamentally, the Pensions Committee members have the opportunity to make decisions. The point that's being made is that the decisions need to be taken based on what is reasonable information on that basis. And if they step outside of that, then I think that creates additional risk for pension fund committee members. In terms of the members, it's not possible to consider all of the considerations of all 50,000 members, which is why generally we refer to the employers and make sure that all of the proposals and recommendations that we make are public, that we engage with employers where we can, and we take those into account when those are brought back. Thanks, Chair.
Okay, thank you. Yes, Karen.
I did have some points. We could do this after a break, but I did have some points on rather than comment in it after every presentation from the various asset managers, because it cuts across. I wanted to just make those points at the end, but maybe we can do that after the break before we move to this motion.
I think let's cover them now,
okay.
and then we can really move on to the debate.
Sorry, I thought I had.
Yeah.
Sorry. So I think for me, the thing that strikes me from both the report and the background papers is we seem to have this impression that somehow divestment and engagement are mutually exclusive, and I don't think they are, or certainly that divestment and net zero are mutually exclusive, and they're not. I think as part of a plan to get you to net zero, as Lgps actually said it in the presentation, that you can obviously reserve the right to implement exclusions and reductions and actually divest. So for me, I just don't understand why we're getting ourselves wrapped up in this idea that somehow we have to completely, move away from any notion of divestment and instead we're going to go to net zero, because as part of a transition to net zero, we would have to divest from fossil fuels. That the whole world economy has to do that. In order to accord with the Paris Agreement. So I just think for me we've got ourselves into a bit of a rut, and we just need to lift ourselves up and be a little bit more open that divestment is part of this process.
Okay.
But that's not what the reports are saying though, Brian, sorry, they're not saying that.
Can I just get
James first, then Patrick.
First very quickly, and I'll go to Patrick. I think certainly in my statement that the point that's being made here is that if it's a manager decision to divest, then that's one issue. If the committee, and if we go back to the council motion, that's talking about the committee making that decision. And I think that's a completely different thing, and that's about transferring the risk across to pension committee members. I think if managers, as part of the engagement that we've talked about, they feel that it's the best action to take, then it's the manager that's taking that risk, and the manager has got all the information in relation to the financial implications of it.
Okay, can I come back on that?
Yes.
But we could, as other pension funds have taken the decision to say, actually, in order, looking at other pension funds, looking at other investments, looking at a range of other evidence, that we feel there are certain metrics in terms of some of the companies that our asset managers invest in, that if within a certain, we've got talked about short and medium term plans, that within a certain time frame, we've still got companies with, over a certain percentage in reserves or revenues, that no longer fits our investment criteria. And the engagement should, short-term, quick engagement should hopefully lead to that. And if it doesn't, then we reserve the right to divest, and that we actively, we utilise the expertise clearly of our investors, but that we're saying to them that's where we want to get to, and we want our investors to use their expertise to get us there, and to protect the fund. If when we do sort of move at, because companies are still got above our whatever our metric percentage might be, and it could be different on different sectors. I appreciate that we then make sensible transfer decisions. I just think at the moment we sort of seem to be sort of saying that actually we can continue to invest in companies that the BMO said might actually increase their oil and gas reserves, which is just a nonsense really, isn't it? That we might continue to invest in a company that does that for the sake of somehow having some level of engagement. That doesn't sit right with me.
Okay. Do you want to?
I'd like Patrick to come in.
Patrick, yes.
Yeah, just to unpick a couple of things there. It's not strictly speaking true to say that you can't achieve net zero in an investment portfolio and invest in fossil fuels. Every 1.5 degree net zero scenario makes assumptions about carbon capture and storage, and we can't actually credibly model a 1.5 degree scenario without contribution from carbon capture and storage. So that's one thing. If that technology does roll out and it works at an industrial scale, then that creates a slightly different dynamic for the fossil fuel industry and those burning fossil fuels, so cement and other industries. So that's just one point there. And we need that investment to happen. That R&D needs to be spent in order to bring that technology to fruition. And then the other point about divestment, there's an expectation amongst all of the managers that manage your funds that they will integrate environmental, social and governance risks into their investment processes. And that should affect their valuations, their assessment of those companies, and they shouldn't invest in companies where they think those risks don't stack up, where management aren't responding to those risks accordingly, and the profile of the company doesn't fit. And if you look through the portfolio, you don't see any pure play coal companies in there because they're not an attractive investment proposition anymore. You don't see a very large allocation to fossil fuels, and you see Shell rather than Exxon. So these things are already being factored into the investment decisions and are reflected in the portfolios, which is why your portfolios are less carbon intensive than the benchmarks. And it's also why you have different allocation to fossil fuels and green tech to the benchmark. So as these signals become stronger, you'll see that tilt and that trend become stronger as it becomes clearly apparent that there are companies that over the longer term are really challenged by this. So it's already embedded in what your expectations are.
Okay, thank you very much, Patrick. Carolyn.
Well, I mean, we can debate it when we won't debate it ad infinitum, but I mean, I certainly feel a reliance on carbon capture is a very risky strategy, and I just think there is a huge amount of evidence to suggest that we do, not just us as pensioners, but globally, we have to stop. We have to really move away and have a very rapid transition away from fossil fuels. Within the next 4 or 5 years, that's the position that we're in globally. Governments aren't moving fast enough, and I guess that makes it harder for us to move faster too. I accept that, but let's be realistic here. That this is the crisis we're facing, and I don't think we should shy away from it. And I'd also just sort of suggest that, I mean, BMO talked about it, they've been engaging for 20 years. Yeah, well, we've had an increase in fossil fuel extraction over 20 years. So I'm glad that you've sort of said that actually moving away, shifting the portfolio is actually part of the plan. So I think that helps when we come to discuss the recommendations in this report.
Okay. I'm very conscious that we want a break. It's 12:10, so if we reconvene in 10 minutes' time, if that's acceptable to everybody. So
can I just confirm the live stream's on, please, before people start?
Chair live again.
Okay. Well, welcome back everybody. We're now resuming the Pensions Committee meeting and the time is now 12:21. We've gone through the reports, we've asked questions on the presentations. We're now coming really to the recommendations and the debate on this particular subject. Now, you've all got the reports in front of you. There are a total of 7 recommendations which are there in the report. I can read them out if we wish, or are you all happy?
We can all read, Chairman.
You can't read. Okay, well, we can all read. Very, very good. So we're now at the stage of the debate and then moving the whole process forward with a vote. So it's over to you members for comments, please. Yes, Caroline.
Yes. For clarification in 3.2 where it refers to global industry standards. So what do we mean by that?
Probably Patrick.
Sorry. In the recommendations 3.2,
yeah,
says that members agree that net zero aligns with global industry standards.
Yes.
So I just wonder what that phrase. Just clarification.
Yes, so government commitments to achieve net zero by 2050, IEA scenarios, IPCC reports, Paris reaffirmed at Glasgow. Hopefully, what happens in 2027 in Egypt? Sorry, in 2022 in Egypt.
Okay.
And in terms of what other investors are doing around net zero, IRGCC framework, TPI.
So there could be a difference. There could be in all of those things. It's not.
How do you mean?
Well, what sort of the IPPCs? So what could be come out of Paris or Egypt could be different to. You mentioned companies. What companies are doing that? I'm just trying to think. Is there a key kind of benchmark that we're working to? That would be what that'll be clearer. I think.
Yeah, there's sector. Well, it's broken down by sector. So there's sector pathways. And not all of them need to achieve the same trajectory of decarbonisation. There's different pathways for different sectors, which is analysed by TPI, for example, the Transition Pathway Initiative, have that data and have done that analysis. For example, if you were to look at a company, is it on its sector transition pathway or not? And if not, then that's an engagement priority.
Perhaps this will become clear when we move to some maybe short and medium term plans, because what you described to me doesn't make it easy for me as a committee member to then measure how we're heading towards net zero.
So in terms of the portfolio?
In terms of that, you know, it just seems a bit sort of vague. But I think if we're talking about medium and short term plans, I guess that will give some more clarity.
Okay, yes.
Roger Evans. Yeah. I had that down as a question, Chairman, and that is 3.3 towards in place short and medium term plans to make progress. What a short term, what a medium? Are we talking about 3 years short term, 2 years, 5 years? Because 2050 is almost 30 years away. Now, is that long term, 2050? So I'd just like to put some interpretation on that, please.
Yeah, so there's interim targets, which are 50% reduction in carbon emissions by 2030. So halving of carbon emissions, which is again, it's a milestone that's established under the IRGCC framework and accepted by IEA and IPCC. That equates to a 7.6% reduction per annum, which is again a calculation that was done by UNEP when in the research analysis they've done on this. And there's another milestone which is 70% of the portfolio or 70% of the financed emissions of the portfolio needs to be either net zero, aligned to a net zero pathway, which is the sector pathways which I mentioned before, or under a engagement program to bring that about, and then that 70% needs to move to 100%. So that 100% obviously increases kind of resourcing requirements in terms of your engagement, which we are recruiting 2 new team members, hopefully joining in early February, and some of their focus will be on engagement. We're also calculating in terms of our financed emissions what percentage is already under an engagement program, and at the moment, if you map the CA 100 to our financed emissions, you get about 46% of our financed emissions are currently under engagement. So what we need to add to that is all the other engagements that are done by EOS, by ourselves, by LAP. So that will boost that number up, and then companies in the portfolio that are either already net zero aligned or aligned to the pathway for their sector. And so we think, obviously the number from 46 is going to go up. We think we're going to be fairly close to 70 anyway, and we'll set a target that's realistic on that. And I don't think that would be anywhere near. I would imagine that we could probably achieve that next year.
Yes, Roger. Thank you, Chairman. Do you think 2030 is ambitious enough, not 2025, 3 years or something like that? I note also that it's a recommendation to use LGIM, low carbon net zero asset, to reduce this carbon. There are others in the market. Have they been considered? Do we need to consider others? Because I'm not sure what they invest in, but I've got comments here that there are others around who can do it. Are these the best in your opinion, or is there some that we still need to look at before make a firm decision that that's what we are going to use?
Louis, please. So you've highlighted in 3.4 in terms of referring to short term. I think those are the short term actions that are being recommended. So, and I think they're going to be a step change towards net zero. That's not a gradual move. That is really quite a major change, which will happen at some point this year. And in terms of other options, we have focused our on what to do with what is available from Lgps Central as the main implementer for the fund, together with what is available from Legal and General, with whom Shropshire, along with the other counties, have a very attractive fee deal with. Now, as it actually happens, Legal and General are a very, very good fund manager in this area, and we have done considerable research, Aon has done considerable research into the indices that are out there that enable a move to net zero by 2050. And the index that we have proposed is one that we've done a huge amount of research into, and we think it is a high quality index and fund manager. So yes, we've done a lot of research and across the board, and focused in on that one as the most appropriate.
So is reduced by half by 2030? If I said 2025, what would be your comments?
5 years earlier than 2030.
Shall I come in on that?
Yes, please do, Patrick.
So if you do 2025, then you're stepping out of what most corporations are working towards at the moment, and what most investors have accepted through the IRGCC framework. So you're kind of, in that sense, you're more going against the tide a little bit, and that might be challenging in terms of both your engagement programme and how realistic that is as a target. Now, the 2030 target is aligned with achieving 1.5 degrees, achieving net zero by 2050, which is the targets that the government have set and was agreed at Paris, and they're science-based targets as well. So we will monitor these targets every year, and we will review them in 5 years' time. So if they're not aggressive enough, that's a conversation that we can have with yourselves and anybody else who wants to tell us that we're not being ambitious enough. And at the moment, it is aligned with industry standards as such in terms of what the current trajectory being asked is. Stepping out of that might be difficult.
I know Brian wants to come in, so just last question really.
I note ABP, and I know what was said about not understanding what they're doing, but I would have thought, looking at other companies, including Oxfordshire and Strathclyde and other pension funds as well, who are all moving, and I would suggest that some of those are moving faster than 2030. So it may be the industry standard at present, but it may not be for too long. I think if you want to be ambitious, then is there any reason why we can't do it? Is there a risk there? Is the risk quantifiable? I'm not sure. I'm asking the question because I understand from James Walton about the risk that we need to do it, but there is also the long-term benefit to our members, the pensioners, the people who are contributing now. If we do not get down to 1.5, then what they will continue to live in, I may not be here, but they may well be. We need to consider what is best for them as well as getting the return that is needed for the taxpayer, so it does not have to add to money that goes into the pension fund to pay the pension of those who are present paying in. Not sure if that makes sense, Chairman, but what I'm saying is that if 1.5 we need to do, are we moving fast enough? What would happen if we went to 2025? And as financial advisors, what would be the risk that you would tell me that I am taking?
I'm not going to answer the question directly because I don't have that analysis, but what I'll just give you a little bit more information in terms of 3.4 and particularly the move from passive, the Legal and General passive fund, which is 30% of the fund's assets. It is actually the biggest part of your equity assets if with Legal and General. I would expect that move to happen pretty soon after this meeting. That would result, looking at some stats in a report which is in the private sector, private section of the report, on carbon emissions, carbon footprint, carbon revenue intensity dropping by 60 to 75%. That's what when I'm saying there's a radical change happening to your carbon footprint happening from that recommendation. That's what I'm meaning. That over half of your equity assets are reducing carbon footprint by 60 to 75%.
That's happening straight away.
Following this,
following
the transition will be organised.
So that really is a real benefit.
That's right. And further to that, the shift from Majetti to sustainable equity will also have a meaningful. I don't have the data on that, but that will have a further meaningful impact.
Okay. Brian, you wanted to come in, please.
Yes, thank you, Chairman. I'm looking at para 3.5 of the recommendations. I'm not happy with the wording of the statement in the middle of this. Members of Shropshire County Pension Fund do not agree that divestment from fossil fuels in the best interest of its 50,000 members. I'm not sure that that's a correct statement, certainly not what I feel. I am happy, and I would like to see the wording that the members of the Shropshire Council Pension Fund are satisfied that divestment from fossil fuels is an outcome that should be pursued, so long as it is consistent with the best investment decisions for our members. I'm happy, and indeed I feel that there should be a degree of divestment as long as it is financially beneficial to the scheme. And that bold statement, members of Shropshire Council Pension Fund do not agree that divestment from fossil fuels in the best interest of 50,000 members, is not actually my view. And I don't feel that I can agree with that statement as it is worded.
I would support that, Chair. Can we have that as an amendment?
I think what we're talking about is any divestment is left in the hands of our managers, because they are the people who have the responsibility to manage our funds, and I think that is important.
With respect, Chairman, that's not what it says.
No, okay. Well, can we alter the wording then to come up with something that everybody is happy with? Because we have to be rather careful, as James pointed out, that we as a committee don't micromanage our pension investments, because then we are going down a very slippery slope. But can we come up with some wording that
If I may, Chair, we absolutely can. We would need to agree what that wording was. The reasoning for that recommendation is particularly in relation to the council motion. So it was specifically relating to that and saying that because we wanted to make sure we were addressing those issues. As it stands, we can amend that, but we need some proposed wording for members to vote on.
All right, well, I'll come back to that. I'll try and draft some proposed wording.
Okay,
That reflects my view.
Yeah, sorry. Yeah, I mean, I think it is important. I think you said we shouldn't micromanage our investment managers, but equally, if we come out with that statement like that, I would argue we are micromanaging, because we're saying we don't want you to consider divestment, and I don't think that's what we are saying. So
no, we're not saying that. We're saying leave it to the managers to actually manage the fund. I think that's what we're saying.
But we need to set, so I think to put a statement like that, and as Brian has articulated, could be interpreted as, well, we won't divest. Even if things are really bad, we won't divest. And that isn't what we're saying. I don't think any of us are saying that. So, I do welcome the points that Brian has made, and I think an amendment is due.
Well, I'll see what I can draft in the next few minutes. We go on to something else.
Should we move on to another item and then come back? I mean, just so I get a measure of everybody else is happy with the rest of the recommendations, I take it. We're just talking about amending the middle bit of 3.5. Yeah, I take it. Roger?
I would like individual votes, Chairman, but also in this 3.5 we're talking about, how do we know what the 50,000 members want? As I understand the papers, the last annual meeting where the members came to was 2019. There was a meeting with the employers, November of last year. It says that we're invited to it. I can't remember receiving an invitation, but okay. But the members, I would think, need to be asked at some time in the near future on what their wish is, so that we can confirm that we're acting. If I come back to the statement that was made and I highlighted earlier on, would not involve significant risk of financial detriment to the scheme, and where they have good reason to think that scheme members would support their decision.
Well, I think the reality is the reason we didn't have an AGM, if I remember rightly, in 2020 and also actually in 2021 was because of the COVID restrictions. So certainly in 20, I think we were in lockdown, if I remember rightly, November 2020, and 2021. If we weren't in lockdown, we were certainly limited on how many people could actually come into this building. So that is why there haven't been AGMs for the members.
Through you, Chairman, there is the Zoom or Teams or whatever facility we could surely use to gauge an opinion and thought. In 2020, we could actually legally make decisions on that and do it. Well, now we can't. For a committee, you have to meet face to face, but surely we can consult with the members and have their contribution.
Justin.
I've got an amendment. Right.
Just to add to that, I think I mentioned it earlier on the report. So all of the pension funds policies are consulted on with all the employers within the pension fund. So we've got the funding strategy statement, the investment strategy statement, the climate strategy. It's all been, we don't go out to individual members, but gone out to all employees of the funds, and all the comments are taken into account before they are approved at the Pensions Committee.
Yes, Roger.
If I can come back, Chairman, councillors who represent the community, the wider community, were they asked to this meeting? I may have been, and I'm not sure if I am or not, but were the councillors, the local members who represent employees, represent pension members for it, so that they were aware of what it's doing, so they can go out and about and talk to it. But I would have thought it isn't beyond their way of doing things, that we could actually consult the paying members as well as the employers.
I think there is a logistical problem. We have 50,000 people that you're suggesting we should go out and consult. Some perhaps could be consulted online, but very many of them are not online, and there would be quite a considerable cost and logistics to actually communicate with them all.
Sorry, Chair, we do have representatives on this committee from all
Yes.
groups.
Yes, we do. Yes, we do. Yes, we do. We have representatives actually on this very committee.
I'm sorry, Chairman, can I come back? It was referred to directly by the director. 50,000 we have, and that was brought up there in the report, that we need to make decisions on behalf of the 50,000.
And we are,
and that's why I query it now.
And we are making decisions, as we have at every meeting, on behalf of our 50,000 pensioners, because that's what we are in the business of doing.
So the members here can actually make a decision on behalf of the 50,000 and not have it queried that are we speaking, because that's how I read the report from the director.
I think what I'm trying to say is the members are part of the pension fund, and we actually make decisions as a committee for the pension fund. I think that's probably what I'm trying to say.
If I may, Chair, there's, we have communication strategies. As Justin said, we engage with the employers. The employers are then perfectly at liberty to engage with their employees, who they're going to have much more relevant and updated information in terms of contacting those. Fundamentally, the reason you have a pension committee is to make those decisions on behalf of the pension fund members. So everything that is done by this committee is on behalf of those members and those employers, and it's simply not possible to put a situation together where we say that every decision that's made by the pensions committee needs to be consulting the members of the pension fund. So we do try and engage. We do have a communication strategy. We do make sure that we all of the information that we provide in this is public. It's there for councillors. It's there for members of the public to access. They can watch these meetings now in ways they couldn't before. We can only go so far in terms of that engagement. And the expectation is that this committee has that sense of what the membership of the pension fund need, and also critically have the information, the technical information necessary to enable them to make the right decisions on behalf of them. And then on top of that, we have the pension board, and the pension board are there to make sure that the decisions taken by this committee are taken appropriately. So I would argue that the governance arrangements around this are very, very strong.
Okay, Caroline.
Yeah, I understand the logistics and going out and trying to survey 50,000 members, and I think, as we've already said, this is a defined benefit scheme, and so arguably the greatest risk is to those people making contributions now. And so working through employers, I accept that. I would sort of reiterate the point I made at the last meeting, though, in relation to the consultation on the climate strategy, that was done at a time when it just wasn't going to get engagement, and it didn't. To send out a survey in August when you've got a number of your employers who are actually schools and therefore not picking up emails and not there and not having governors meetings to make those to assess that and make a response in August, that it was meaningless consultation. And two responses. One said that they wanted the fund to divest. That's a 50% return if you want to argue it like that. So I think that is absolutely something we must come back to, in terms of understanding that we are meeting the needs of our employers and those employees who are contributing into the scheme, because if things do start to go the wrong way, it'll be increased contributions that will have to happen. So that's just one point. I think in terms of moving this forward and the recommendations, I think there's what I'd like to understand really is we've had a question about what is short and medium term, and I guess I'm sort of how are we going to get that reported back to us? So we're going to make a pre-recommendation to put in place short and medium term plans. When will they come back to? Well, will they come back to us for us to say that we're happy with those short and medium term plans, that they set in that step down in the appropriate way? When will that happen? Thank you.
Sorry, can I just reference the first point? If I just reference the first point, I just want to just make something very clear. There's 2 or 3 points within this. Number one, this is a defined benefit scheme, so pensions are not being impacted by these decisions. They are defined. The employees' contribution rates are not set by Shropshire County Pension Fund. So the employees' contributions are set nationally. The only one that is set locally by Shropshire County Pension Fund is the employers' contributions. Hence, it's very important that we continue to consult and discuss with employers. But the reference that was made around this impacts on employees' contributions is not correct.
That's accepted, Chair.
Okay, James.
Yeah, and just to follow up, obviously, like the last 18 months, we're going to have every pension committee meetings. There's going to be updates on this. You know how important it is. So we're going to have additional climate risk reports on an annual basis. So we'll be monitoring this and reporting back, like we have been for the last 18 months. So we'll be picking it up at the majority of pension fund meetings going forward as well.
Okay, Brian.
Right, Chairman. Well, I would like to move this as an amendment. It means deleting the clause that starts members of the Shropshire Council Pension Fund and ends with 50,000 members, that central clause, and inserting instead, members of Shropshire Council Pension Fund are prepared to accept divestment to a timescale recommended by our financial advisors, so as long as it accords with our overall objective to manage scheme finances for the benefit of its members. And then the word "but" would be deleted, and you would start with a commitment would start with a capital C. I'll read that again.
Slowly, please. So
yeah.
we can actually all write it down.
Members of Shropshire Council Pension Fund are prepared to accept divestment to a time
Hang on. Sorry, are prepared to
accept divestment.
Yeah.
To a timescale recommended by our financial advisors. This is to
hang on to timescale.
I'll explain that clause because to a timescale recommended by our financial advisors. I'm trying to cover the situation that James mentioned, that we shouldn't be trying to take the decisions and the technical decisions ourselves. To a timescale recommended by our financial advisors, so long as it accords with our overall objective to manage scheme finances for the benefit of its members. So long as it accords with our overall objective to manage scheme finances for the benefit of its members. I can read the whole thing again now, if you like. Members of the Shropshire Council Pension Fund are prepared to accept divestment to a timescale recommended by financial advisors, so long as it accords with our overall objective to manage scheme finances for the benefit of its members.
Simon.
Thank you, Chair. I just feel we have to have in there something regarding the commitment to net zero carbon emissions before 2050. Otherwise, that's just.
Well, that follows, Simon, if we're still leaving in.
Oh, you're still leaving in. I'm sorry, Brian. I thought you were taking out the whole.
No. I'm only taking out as far.
My apologies, withdrawn.
The 50,000 members. Right, we then start again with a new sentence instead of a clause. capital C in other words, commitments to net zero carbon emission for 2050, etc., etc., as worded in the report. That still stays in.
My apology.
Yeah,
Sorry,
yes,
as
yes.
an advisor.
Yes.
As an advisor, I'm not sure I'm comfortable with the onus put on me, Aon, and possibly Roger as well, that you're waiting on our recommendation.
Well, I'm trying to cover the situation that James said.
So I think the policy, I'll say where I think you're trying to, I think the strategy set by committee is net zero by 2050.
Yes, still there.
So absolutely. I think the implementation of that strategy is down to Lgps Central and your fund managers. And as part of that implementation, yes, the fund managers and Lgps Central will engage and won't invest in some companies. So I'm separating out Lgps Central and your managers who are implementing the strategy. I am an advisor. Most of my focus is advising on the strategy. So my advice is net zero by 2050. The implementation is by asset managers and Lgps Central. They have within their power, which I think is what you're trying to say, to not invest in companies, which you could call divest if you want to achieve that net zero by 2050 goal.
I don't disagree with you, but the statement here, members of Shropshire Council Pension Fund do not agree that divestment from fossil fuels is in the best interest of 50,000 members.
So
doesn't represent my view.
So can I, just your wording, one possible way you could change it, members of Shropshire, etc., accept disinvestment to a timescale implemented by Lgps Central and the fund's managers, so long as achieving that.
Yes, as long as it doesn't state that we members are not prepared to accept divestment. It sounds to me like that your wording is more suitable than mine. Would you like to read your wording again?
So I'm replacing, and I'm not trying to wriggle out, I'm just trying to be clear on who's responsible.
Yeah, that's no view.
So I'm replacing the recommended by financial advisor with implemented by Lgps Central and the fund's investment managers.
That's fine.
Yeah, that's clearly where the responsible is.
Yeah. If I may, Chair, there is another option which might be simpler.
Yeah.
Which just takes out the through a timescale recommended by our financial advisors, and just say members of Shropshire County Pension Fund are prepared to accept divestment as long as it accords with our overall objective to manage scheme finances for the benefit of its members. In that way, it's not, because the only issue I've got with Louis' suggestion is if we change managers or things change in the future by singling out a few
well, as long as you're happy that when the pension fund trustees are not trying to dictate where we put our money, which was what the implication of what you said earlier, James, in response. So we're cutting out members of Shropshire are prepared to accept divestment to the same, and so long as it accords.
Yeah, so delete through a timescale recommended by financial advisors.
Yeah, fine.
And instead just say
members of Shropshire Council Pension Fund are prepared to accept divestment so as long as it accords with our overall objective to manage scheme finances for the benefit of its members. And then we go on, commitments to net zero carbon emissions for 2050, etc., as is worded in there. I'm happy. I don't know whether anybody else is.
Can I ask a question? When you say that the benefit of scheme members, there are a number of ways of interpreting what your fiduciary responsibility is in terms of climate change, and therefore would it be worth inserting the financial benefit of scheme members? Otherwise, you could interpret the benefit.
Yeah, happy with that. The financial benefit, yeah.
Chair, could we not take it back to the phrase that's in there, which is the best interest of? And I think that then goes slightly further than finance.
We're getting there. We're getting there.
Yes, Justin, please.
So couldn't we get that bit about members of the Shropshire County Pension Fund, 50,000 members? It's just a suggestion, obviously. Could we not remove that and just leave it as members agree that following advice from industry experts, public government statements made on climate change, an extensive 18-month training programme on climate-related issues, members agree commitments to net zero carbon emissions before 2050, setting carbon reduction targets, and collaboration with other like-minded investors is the best way to tackle climate change and make a real difference to the outcome. Just take that bit about members of the Shropshire Pension Fund do not agree with divestment or the 50,000 members.
Yeah.
That's much simpler, and that's what
Okay,
we're
fine,
agreeing to.
as long as I'm not committed to not.
Yeah.
Sorry, can you just run over that again? I didn't.
Yeah, so 3.5, so it would read, members agree that following advice from industry experts, public government statements made on climate change, an extensive 18-month training programme on climate-related issues, there, comma, members agree to commitments to net zero carbon emissions before 2050, setting carbon reduction targets and collaboration with other like-minded investors is the best way to tackle climate change and make a real difference in the outcome. So it's basically the same as the recommendations, but just exclude that members of the Shropshire County Pension Fund do not agree that divestment from fossil fuels is in the best interest of the 50,000 members, but commitments to net zero is.
Yeah. Yeah.
I accept that amendment to the amendment to the amendment to my motion.
Okay.
I don't. I prefer yours, right? I don't think that responds to the motion. I think we then lose sight of responding to the motion. So I think the wording that, so Brian, you started and James, you finessed and shortened. I think that for me is the better. Better motion.
I prefer Brian's the latter one.
Was in the best interest of the council motion in July 2020.
No, the what you just read out. Yes, what you just read out suggested. Can you just read that out again? Sorry, what your
So members agree that following advice from industry experts, public government statements made on climate change, an extensive 18-month training programme on climate-related issues.
Yeah.
Members agree commitments to net zero carbon emission before 2050, setting carbon reduction targets and collaboration with other like-minded investors is the best way to tackle climate change and make a real difference in the outcome.
Yeah. Yes, I like that. Yes, I think that's. Yes, Caroline.
I think I maintain that I don't think that responds to the motion, which was specific about divestments. I think you have to address what our position on divestment is, and I think that the wording around, that we are prepared to accept divestment, and we've had lots of discussion saying that happens. That we have moved away from some coal investments, for example. So I don't see what the harm is in having that in, because I think that then sets some clarity to those people, out there who think that we aren't doing anything in terms of divestment and moving away from fossil fuels, but actually we are. And I think it's having that bold statement that says that we are prepared to accept, subject to the rest of the statement that Brian and James sort of put together, addresses that central point and responds appropriately to the motion.
Well,
so maybe we need to vote on both.
Well, yes, I still feel that there should be a statement that we are agreed to divestment, accept divestment, but I don't want to divest everything tomorrow. I want to do it to a time scale that accords with our overall financial objectives, and that's what members of. So we're now I will move this. Members of Shropshire County Pension Fund.
Just come back before we move things. I've just got a suggestion with.
Sorry, Tom, microphone.
Oh, sorry. I've got a suggestion to add to Jason's. I see we need to put the word. We're thinking of the word divestment in some shape or form added in. Members agree commitments to net zero emissions before 2050, setting basically what Jason has said, and then tag on the end, this does not exclude divestment. What do you think about that?
I think it was in Aeons, I can't remember which one now, but I think what we're proposing goes above and beyond what was in the council motion by setting the net zero target by 2050.
Yes, it does.
So that's the key point
does.
is by setting all the public statements that have been read out, say that setting the net zero by 2050 or before is setting interim targets, 30% and 50% reduction by 2030, goes above and beyond what was put in the council motion in July 2020.
Well, somewhere along the line, I wish to get rid of that statement. Members of Shropshire County Pension Fund do not agree that divestment from fossil fuels is in the best interest of 50,000 members. Even if we just return to 3.5 by deleting that whole clause, then we've not made any statement on divestment, but we certainly haven't said that we don't, as members, agree with divestment.
Roger.
Thank you, Chairman. The actual council motion is 3 years, not 2030, not 2050. It is 3 years in the council motion, so we're not going with the council motion, we're going where we think our fiduciary duty is, so we're going down there. The council motion was a lot faster than what we are proposing. I noticed that Leeds City Council in September agreed to a set of comments that they asked for, and they said actively look to divest into alternative cleaner investments with comparable returns. I like that sentence.
Yes, because comparable returns.
I'm not micromanaging.
If you micromanage that, Roger, Glencore returned 60% last year. Your renewables about 4%. So you're ruling out growth for the pension fund. That really is micromanaging the thing.
I understand that, Chair, but I think that sentiment there. I said the words. Okay, we're arguing about it. It's that sort of thing that we need to. We are when Justin said about the council motion is a lot more onerous than what we are proposing, because we do have that fiduciary duty.
Well, no, it isn't, because going net zero by 2050 is far more onerous than what the motion. That's what Justin just told us. Yes, Roger. Yeah.
Wouldn't your statements be more credible, actually, if you talked about the 2030? Was that your intention, to talk about the 2030 objectives? There clearly is a risk to that, in that I assume that they're quite demanding, and no reason why we shouldn't sign up to that. But I think one of the issues here, and I share some of the concerns, that 2050 is a long way, and we talk about short and medium term plans, and to me, for instance, a short term plan is a 12-18-month rolling plan. So if we were to talk about the commitments that have been alluded to around 2030, then I think you have a powerful statement in that not only have you signed up to something longer term, which to be fair pretty much everybody else has signed up to, but you've differentiated yourself, which might give you credibility in terms of the original council motion by talking about something in 2030.
Okay. I mean, the reality is we are, with the implementation that we're about to take place after this meeting, we will achieve a lot very, very quickly. What about the time scale 2030? What are people's views about that?
Well, it's a fundamental part of the IRGCC framework. That's a key milestone. And plans to 2030 are much clearer than plans from 2030 to 2050. So it does seem appropriate to talk about that.
I mean, if the plans are well defined, I would have thought that we should allude to them, because that really gets over this problem of saying, yeah, 2050 is just too far out there. We all understand the point that was originally made in the in the presentation about the next 3 to 4 years. And 2030, a 2030 target, which is implicit, as you say, in the 2050 target, looks to me something quite important.
I would agree.
So can we come up with some wording then? Yes, Byron.
Oh yeah. To be honest with you, I think Brian had it pretty spot on then when he proposed his motion, and then the chap afterwards amended it. I think that pretty much covered it. We've sort of, from my point of view, gone a little bit confusing now and gone off track as to what the original one was.
I think we need to be careful that we don't overcommit to divestment, and therefore we don't accept that some companies will play a very important part in transitioning from the old fossil fuel economy into new energy companies. And I think we just need to be careful we don't end up throwing the baby out with the bathwater. I think that's a fair comment, isn't it? Because we are actually going to rely on companies like Shell and BP to successfully transition over the next decade or so to actually achieve real decarbonisation in the world. But, you know, not talking about sort of paper activity, but actually out there, actually cutting physical carbon emission down. And what I don't want to do is end up with a motion that actually equally stops us helping them on the journey that will actually benefit us all at the end of the day, pensioners and public.
Tom, with respect, Chairman, I don't think my motion to accept divestment, so long as it accords with our overall objective to manage scheme finances, precludes us from continuing to invest where it is beneficial in Glencore and other companies.
Okay, well,
I'm not suggesting that the wording does not say we must divest from all 9 companies specified in this report as being still producing products which pollute. I'm trying, so far as possible, simply to avoid the perception that we are totally, as members of this committee, against divestment, which is what might be assumed from the statement that is in 3.5. So I go back to my simple statement as amended by James. Members of Shropshire Council Pension Fund are prepared to accept divestment so long as it accords with our overall objective to manage scheme finances for the financial benefit of its members. And the way we manage those scheme finances may well include an element of acceptance of some financial involvement with companies like Glencore.
I just think you have to be concerned a little bit about ambiguity there and what people might interpret that to mean. And I wonder whether you could say, it sounds to me like you're not advocating a divestment policy here as passed by the committee, but there is an expectation that your managers will integrate environmental, social and governance considerations into their investment processes and divest from companies accordingly on a case-by-case basis, which sounds sensible and in line with what the industry are proposing. I just wonder whether I just think you've got to be careful about divestment means different things to different people. And I think it's a divestment policy that you're not favouring here by the sound of it.
Well, simply the wording that we don't agree with divestment. Most of us do agree that divestment is a good thing or a beneficial thing as we move towards 2050, so long as we don't damage the financial objectives of the scheme to ensure that the fund is 100% funded for our members. You know, I'm trying to say something simple, and advisors, for some reason or other, are trying to complicate the issue. I see nothing wrong, I wouldn't, would I, with the statement members of the Shropshire Council Pension Fund are prepared to accept divestment so long as it accords with our overall objective to manage scheme finances for the financial benefit of its members. And then we go on, as I say, with the last 4 lines, commitments to net zero, etc., etc. And I move.
Councillor Williams, I don't think you've got your microphone on.
Right. And in order to make progress, I will move that.
Second.
Sorry, Chair, can we just read that out again? Because I don't know if the live stream would have picked up that proposal.
Right. Members of Shropshire Council Pension Fund are prepared to accept divestment so long as it accords with our overall objective to manage scheme finances for the financial benefit of its members. To be followed by the words that are in here, commitments to net zero carbon emissions, etc., etc.
Could I just change that slightly, and rather than say accept divestment, we do not rule out divestment, which is actually what we've been talking about. I think that would be better, and it's slightly less ambiguous, and it's
okay. Sorry,
yeah.
Your
microphone. Sorry, I'm awfully sorry about that.
I would accept what the chairman said, because the chairman is a man of great wisdom. Members of the Shropshire Council Pension Fund do not
rule out
divestment. Okay,
so long as yeah.
Shall I read out the entire recommendation as far as I see it?
Yeah.
And then
yeah.
hopefully
Right.
everybody will, if we're at that point. Okay, so the whole recommendation 3.5, as I see it, is members agree that following advice from industry experts, public government statements made on climate change, an extensive 18-month training programme on climate-related issues, members of Shropshire County Pension Fund do not rule out divestment so long as it accords with our overall objective to manage scheme finances for the financial benefit of its members. Commitments to net zero carbon emission before 2050, setting carbon reduction targets, and collaboration with other like-minded investors is the best way to tackle climate change and make a real difference in the outcome.
Yeah. I'm happy with that.
I'm happy with that.
Okay.
Do we need to say divestment from fossil fuels rather than just divestment? Yeah. So again, that was specifically what the motion was about. So it's just putting those couple of ways back in, but
yes.
And then yes, I would support.
Yes, Simon.
Actually, the motion was fossil fuel dependent companies, and I think we should stick with the motion as it was. So to support what Caroline said,
Yeah.
Fossil fuel dependent companies, which of course is a lot more than just Shell.
Yeah, yes, it's considerably.
That's what was said in the.
It's considerably more than fossil fuel producers.
But that is what was said in the council motion. Sorry. So, like, if we just stick with what we were asked to look at, not support what Caroline said, just with that extra end of word. If you're okay with that, Caroline.
Sorry. I'm just searching through the council motion to try and find where exactly it says that.
It's the second one, I think.
Can you help me, Simon? Second paragraph?
No. There's 3 points, and I think it's the second one.
Oh, sorry, the second point.
I think from memory, those.
Okay.
Do you want to read it again?
Yeah, please. Yes.
Okay. Just so that we clear. Okay. Members agree that following advice from industry experts, public government statements made on climate change, and extensive 18-month training programme on climate-related issues, members of Shropshire County Pension Fund do not rule out divestment from fossil fuel-dependent assets, so long as it accords with our overall objective to manage scheme finances for the financial benefit of its members. commitments to net zero carbon emission before 2050, setting carbon reduction targets and collaboration with other like-minded investors is the best way to tackle climate change and make a real difference in the outcome.
Okay, yeah.
I'll move that as an
Okay.
amendment then.
And Simon will second it. Okay. So should we move to a vote on that then? We've got the recommendation in front of us. All those in favour, please. And that's.
Just on the microphone, Councillor Biggins.
Oh, sorry, beg your pardon. We've moved to the vote. The vote's now been taken and it is unanimously in favour. Thank you all very much for that. I think that was very good. Thank you.
Shall I then move the overall amendments 3.1 to 3.7?
Yes, including what we've just, the new 3.5, yes, the new 3.5. Carolyn?
Sorry, just come back, so I keep coming back to this, the sort of short and medium term plans. So it's, I mean, I don't want to labour it, because there's a big discussion on this, but I just wonder if we need to sort of have something in the very big in mind, you know, Roger's points about 2030, but there's just something around, we want this action to be front loaded, don't we? We've all said that. And so do we need to sort of really, what can we say? So approve the fund, quickly short and medium term plans to make progress towards net zero by 2050. You know, with, I don't know, we need something, I think, that really ramps the action up in the early phases, and I don't quite know what the wording is.
Yeah, I think, Caroline, if I may, I think you're looking for clear measurement.
Yes, I think something about those plans, yeah.
And can I suggest an agenda item at each, I don't want this lost in climate change reporting and all the blah, 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 but an agenda item for every future pension fund that we address specifically. There's some, the pathway that we're on.
Or that we, you know, that we have something in that sort of says that those action plans are, you know, Paris aligned, that we're aligned to 1.5.
Yeah.
Suggestions?
I said all, I'll say as well as regular reporting.
Yeah, I think regular reporting, we yes, quite rightly, we do need it, but I think every single committee meeting is probably over the top. I would have thought
I'm fine with
half
that,
yearly,
Chair.
half yearly would, yeah, because sometimes our agendas are very long. So, what do we want to? Do we want to add anything, or is that sufficient that we are going to be looking at this every 6 months anyway?
I think if that's limited, that we're doing that every 6 months, then yeah.
Oh, okay. Everybody happy with that? So that the 6 month monitoring actually comes out of this motion, but it is we're all agreed on it, and Sarah, if you could sort of minute that outside the recommendations. So coming back to the recommendations, we've got a new revised 3.5 which has been inserted, which we're all unanimous about. And are we therefore happy to en bloc vote through 3.1, 3.2, 3.3, 3.4, the new 3.5, 3.6 and 3.7?
Chair, I'd like to move that we take the recommendations in the report individually.
I'll second that, Chairman.
Well, we can do, but I would actually I would prefer to take them on block. I don't know what on block. Yeah, on block. Okay. So
Can I ask that we have a vote on that, please?
yes,
Perhaps a recorded vote?
absolutely. It's an either or. So we either vote for them.
Sorry, microphone.
Oh, sorry, beg your pardon. Sorry. We either vote yes for. Sorry, I'm just having a senior moment. We vote yes.
It's on block or
on block. Sorry, yes. We either vote for taking the recommendations individually, so that's a vote for, or a vote against is on block. And it's been moved by Ray and seconded by Roger. So all those that want to take the recommendations individually, please show. That's Ray and Roger. And all those that want to take everything on block, please show. That is myself, Simon and Brian. So there's a majority that we take it on block. And any abstentions? Carolyn?
So it's a different one because I think.
Well, you've abstained basically.
Yeah,
So
okay,
so we're going to take it on block. So if everybody's happy, I will move that we take all the recommendations 3.1 through to 3.7 with the new 3.5 on block. And I'd like to propose that. Can I have a second, please? Yes. Brian? Okay, so all those in favour, please show. So that's 4, Carolyn, Simon, Brian and myself. And those against, please. Ray against and Roger against. So the motion has been carried. Thank you very much. Very good. Well, that brings that item to an end. But before we leave, I would just like to thank our officers, particularly our advisors, Lgps Central, BMO, Elgin, Roger, for the considerable amount of work that they have put in preparing for this particular item and the enormous amount of training that's gone on over the last 18 months of committee members and the quite staggering amount of presentations that have been brought to committee during that period. So on behalf of the Pensions Committee, I'd just like to record our thanks. If you could please minute that, Sarah. Moving on now to item 10, corporate governance monitoring, and that I believe is Justin.
Yeah, thank you. Yeah, so this is the quarterly routine corporate governance report that members receive. So it provides details of all the voting carried out by managers at annual meetings during the last quarter up until September. It provides an update on the BMO's engagement with global companies on the fund behalf, and it also outlines Lgps Central's, Legal and General's and Majeddi's ESG policies and updates during the quarter. So happy to take any questions. This is the standard routine report that comes every quarter to the committee.
Any questions, please, members? Roger.
Thank you, Chairman. I presume it might be a misprint, I'm not sure, but I notice on page 109 of the report, BP PLC Energy, there is no tick in the climate change box in there. I presume there should be a tick, should there, or a dot, whatever.
I can check that. But you come back to you.
Any other questions? Yes, Carolyn.
Just, I think in terms of the kind of manager voting activity and the responsible engagement activity, I'm just trying to understand, is there a way of reporting on the impact of that? So we have reports that tell us where we may have, you know, people acting on our behalf have voted against things and the nature of the voting against, and they're often to do with things like governance and rather than, I guess, you know, some other issues. But we don't then get anything, a sense in the report of, well, what impact is that engagement having?
Yes, as we discussed before with BMO, there's milestones, so they can bring those to future meetings, so they can discuss the engagement and milestones that have been achieved. So I think they said there's 78 climate-related milestones that they've achieved on behalf of the Shropshire County Pension Fund. So more detailed information can be brought, always available if you wish.
I think it would be good to have that understanding of what we're putting a lot of, you know, we're putting a lot of emphasis on engagement, aren't we? So, and it's not just about climate change, you know, it's social issues as well. So I think it's just understanding what that impact is, and I think that would be, I'd welcome that being fed back to committee.
Okay, well, in that case, let's move on to the recommendations. It's just one recommendation, 2.1. Members are asked to accept the position as set out in the report, manager voting reports Appendix A, and BMO Global Asset Management Responsible Engagement Overlay Activity Report as Appendix B. I move that. Seconder, please. Yep, Roger, all those in favour? Thank you very much. So we'll move on now to item 11, which is corporate governance monitoring, and over to Debbie, please. Sorry, I beg you.
You're right.
I've missed one out. No, I haven't.
You're right on item 11.
11,
the
the
title.
pensions administration monitoring. I do beg your pardon. Yes, yes. Sorry.
Thank you, Chair. The report's updating the committee on workloads, performance, the dashboards, all of the elements that are coming into effect over the next few years that are affecting local government pension funds, as well as other pension schemes across the whole of the country, really. Pensions increase for our pensioners has been declared at 3.1%. The employers' meeting that was held back in November was sent out an invitation to the Pensions Committee as well as Pensions Board, and just wanted to also bring to attention the Pensions Committee about completing the pensions regulators training modules. Training is required. SIT for knowledge and skills, which is supported by the pensions fund here in Shropshire, covers 8 areas that cover the whole gambit of pensions, investment, the administration, and across the pensions board, officers and committee. There are different levels that are expected depending on your role as to who's expected to be an expert, who can have basic knowledge and who should be conversant with. And we do monitor this across the whole 3 areas. So at the moment, we just need to update on the training modules for the pensions regulator, and then we'll be reassessing the skills and knowledge across the whole of the pension fund. And the SF3 data has been published, and we've just highlighted a few areas around the pension funds as a whole across England and Wales. And I'm quite happy to take questions. Thank you, Chair.
Okay, thanks, Debbie. Any questions, Roger? Thank you, Chairman. It's just 9.6. Can we have an update when that is considered? That's a meeting of the fund of meeting, an annual meeting, which is referred to in that. And I note that provide an update early in 2022. So when possible.
We will. Yes, agree.
Okay. So the recommendations, our members are asked to accept the position as set out in the report. I move that. Seconder, please. Yep, Brian, all those in favour? Okay, thank you very much. Item 12, the exclusion of press and public. To consider a resolution under paragraph 10.2 of the Council's Access to Information Procedure Rules that the proceedings of the committee in relation to agenda items 13 to 17 shall not be conducted in public on the grounds that they involve the likely disclosure of exempt information as defined by the categories specified against them. I move. Seconder, please. All those in favour? Thank you very much.
I'll just ask the live stream.
Okay. While we're waiting, do we need another break or shall we press on? Another break?